home costs and the cost of shelter. This is going to be a key issue in 2022.
13 minutes away from this press conference, Lisa Abramowitz, Tom Keene, and John Farrell is well here. The Fed decides, John, we've got to look at the data as the yield market does a little bit of a walk to a higher yield structure.
Yield's pushing higher, Tom, and it's all been about the front end to the belly of the curve for this Federal Reserve since September 22nd, the last time they met. Into the belly, 5 years up, 6 basis points now to 1.2%. The two just short of 50 basis points. We breached that in the last week. I think we should question the connection between monetary policy and financial conditions. And the reason I ask that, and the reason I think we should ask that question repeatedly, in economic history, in recent economic history, Tom, one of the frothiest markets we've ever seen was approaching 2007. And through that, over the few years into that, we had higher interest rates, Tom. Interest rates were climbing through all of that, and risk appetite kept piling on and piling on and piling on. And I do think we should question this idea that you go instantly from pulling back on QE to introducing higher interest rates and financial conditions just immediately tightening and equities falling from all-time highs. Because, Tom, in history, we've seen examples again and again, in fact, where it doesn't play out that way.
Scott, what I find so interesting, or Scott Minard with us as well, is that Michigan, even with their loss to Michigan State and Diane Swank learning there about savings, you understand savings is a murky and a mysterious thing here. Scott Minard, how do you respond to the reality of the excess savings within our system?
Well, I think, Tom, what we really have here, and I think there are two elements to this excess savings. There is the excess savings that we're measuring, and then there's the home price appreciation that has built up in people who have homes and who can tap that appreciation for future consumption. And so I think this is giving us a real cushion on the consumption side, that this savings will either slowly get spent directly or indirectly through investment. And I think we just basically have the fuel to keep a bull market going.
Diane Swank, we have a moonshot in the banks noted moments ago by the Keefe-Bruyette Bank Index, which is, folks, very good mathematics describing the American banking system. Diane Swank, is this Fed policy a policy of the financial elites as we see within the KBW index?
Well, actually, what the Fed is trying to do is favor, as Lisa pointed out earlier in the show, they're trying to make the lesser of the two mistakes and trying to allow the economy to catch up and reemploy those workers who lost their jobs. And there's lots of frictions in doing that. And they're willing to overshoot a bit on inflation, and asset prices are on the side of that in order to allow that catch up. Ultimately, though, inflation, and I think one of the things that gets lost in translation, and Scott really hit the nail on the head with the issue of equity in people's homes. I do think we're going to see the saving rate, which in September dipped to 7.5%, almost pre-crisis levels, go lower as people tap into their home equity lines of credit. The bad news is that those workers who lost all their unemployment insurance and all the supplements and the things that had kept them afloat, that had also helped juice some underlying demand, that savings will be gone by the end of this year. And it really gets to the inequality issues out there. And this Fed has really focused on trying to get employment back as an equalizer, even though, unfortunately, their tools tend to stoke asset prices faster and more rapidly than they get employment going again in the middle of, as you rightly pointed out, a pandemic. The course of the virus still determines the course of this economy, as we saw in the third quarter, and I think that's very important to remember.
Scott, I do want to go back to what you were talking about earlier in the show, flicking at the potential for recession in the upcoming years. What's the trigger, given some of the strength that we're seeing and the dovish tone under the Fed?
Well, I mean, our work shows that when you get forward rates to invert, and we've done work on this that shows that for the first time since 2006, we're getting there again. Well, actually, we did get there too in 2016 and 17 and 18. This is the stuff that tells you that you're probably looking at the first straw in the wind of a recession that's 2 to 3 years out. Now, it's interesting, the causality. There are two ways to get there. One is an exogenous shock, which is the kind of thing we had with the pandemic. The other way is to just start to see a slow erosion within the economy. So, let me give you an example. An exogenous shock right right now will be a spillover from the property crisis in China. The other route is, of course, that as we've been talking, and the economy starts to lose momentum because inflation doesn't come down, and that's real growth is reaching the levels we have, and the Fed is tightening, then all of a sudden, it's the straw that breaks the camel's back. And I think that where that moment comes, whether it's the exogenous shock or it's just the burnout of the economy, is where the Fed is going to have its greatest challenge, because it's going to have to choose between an inflation rate which may be higher than what they're targeting at 2% versus taking the risk that would be related to a collapse in asset prices, which would potentially be devastating to the financial system.
Scott, let's war game this out right now. Let's say everything you just said could be true. In 3 years, you get a recession. In fact, I'm going to guarantee you one right now. Let's play the game. You've got one in 3 years.
Right.
What would you do differently tomorrow? How would you change your capital allocation decisions?
Well, Jonathan, right now I would stick with the risk-on trade. It's interesting. You made the point a few minutes ago about rising interest rates historically have actually been good for stock markets because it shows that there's growth in the economy and there's confidence. So, I think that the initial phase of rising rates, you stick with the risk-on trade. But you start to look for indicators. And one of my favorite indicators of a recession is, 3 successive negative prints of leading economic indicators. We're far away from seeing that right now, but that I would be long until I started to see those kinds of signals.
You've touched on the hot button issue, and Diane Swank, I think you're perfect to answer this question. If we need to hike interest rates anytime soon, is it for good reason? Is it for good reason, or is it the EM dilemma that we're responding to? Is it for good reason?
That's a great question, and we just don't know. And I think there's a really interesting issue here, too, is that all of the rate hikes that you cite that the market ended up doing well through were the Fed being preemptive about a non-existent inflation, not the Fed chasing inflation. And I think that's one of the things that's a different dynamic. And I would add on to one other way we could get a recession, in addition to rate hikes, is that we could have this bullwhip effect on supply chains. People are double ordering right now. By the time we get into the end of 2022, 2023, we could have an unwanted rise in inventories as demand normalizes or even cools a bit in response to rate hikes, and that could trigger a more traditional inventory-led recession. This is a more of a boom-bust cycle kind of scenario, and it's very different than anything we've seen since the early 1980s.
But let's wrap in here, Diane Swank, and you're such a student of this with the National Association for Business Economics. Our present politics with this chairman, maybe he has a job next year, maybe not, all wraps around inequality. Nothing shows that better than the expansion of a 25-year Keefe-Bruyette index, which shows a moonshot for the haves, a moonshot for the elites. Can we sustain that?
No, and it's not good for the economy. I mean, this is one of the things that the Fed, racism and the economy events have all been about, and the Fed has been looking at, and it's why they're trying to hedge on this side of allowing the economy to grow, because what they realize is the latter part of the expansion, they were wrong in 2018 by preempting a non-existent inflation, and by allowing the unemployment rate to drop lower, they got to narrow the unemployment rate between black and whites, and that was really important because an economy that works for all is a bigger economy for all as well. It increases the size of the economic pie. But that's really hard to do as we're going forward in here, because not only did the pandemic expose many of these inequalities, it also exacerbated them. If you own a home, you've got a lot of equity. If you don't, you're having a hard time paying rent right now.
Lisa, this is so important, and the Keefe-Bruyette index shows that on radio, it's very clear here. You've got the crash of 07, 08, 09, a recovery, and then the fiscal moonshot, Lisa Abramowitz, that we've seen off this pandemic.
Yeah, and the idea that some of these banks have not been lending as much as they would like to because of that fiscal moonshot. And I wonder, Scott, as we get the bleed off from that fiscal support, how we view which constituent we really emphasize here. In other words, can the Fed really meaningfully support the economy if it doesn't get hiking quickly and soon?
Well, I mean, look, what the Fed is doing is something that the Fed was never designed to do. The Fed was designed in 1913 for the purposes of providing liquidity in moments of crisis, not to deal with income inequality. And, you know, to Diane's point, I think that this attempt to use the Fed is creating another level of inequality, which is wealth inequality. And, you know, the haves and the have-nots, and that gap in our society is the sort of thing that you see that precedes, like, the French Revolution. So, you know, this is very politically divisive, and I think that, you know, it's very difficult in an environment like this to get ourselves back on track with so much inequality in the system.
Scott and Diane, the news conference about 3 or 4 minutes away. Just a final question for you both on all of this. Is Chairman Powell the chair of this Federal Reserve this time next year? Diane, is he?
I think he will be. I think it would be a wise idea to just go ahead and keep the continuity at a time when uncertainty is so high. That said, you know, who knows? But I think Chairman Powell will be Federal Reserve Chair a year from now.
Scott, final word to you on that.
Well, I think the wisdom Diane expresses is correct. I think, however, it won't be that he won't be the chair because the populist wing of the party, Elizabeth Warren, has made it very clear that she does not want this man in charge.
Scott Minerd, thank you, sir. Diane Swonk of Grant Thornton. Scott Minerd of Guggenheim going into this Federal Reserve news conference in about 2 minutes' time. Tom, there's going to be a question on that in the news conference, you know. There's got to be. The future of Chairman Powell.
Yeah, you know, Mike McKee's rude enough to ask the question, and maybe there'll be somebody else there that will ask it. I do agree, John. You made a point earlier, which I'm too polite to bring up, and, you know, you bring up the impolite fact is how does he amend and adjust to these realities? And the answer is he doesn't. He's going to play it straight. But coming off the election, John, and with Murphy ahead right now, 15,000 votes in New Jersey, for all of these people in Washington, the calculus changed last night.
Yep, I've had a few people reach out to me as this show has progressed, Lisa, who have suggested that the wings of the progressives have been clipped,
yes,
which should encourage a decision to renominate Chairman Powell.
The issue, though, and this is actually a question I hope gets asked, how do they ensure continuity? How do they ensure a vision that can get carried through to next year if that uncertainty as to who will be at the helm persists?
They've done this before, and they'll figure it out. They'll change the curtains, decide what's new to eat for lunch.
It's different this time, Tom. Honestly, this is a different kind of scenario with such binary types of outcomes and the potential risk being literally opposite depending on who you speak with.
If you're running a business or an institution, when you're at an inflection point, Tom, a change in leadership often isn't the wisest move, is it?
Well, that's what we heard from Diane Swonk.
The strategy to lead the strategy.
Yeah, don't listen to me. Listen to Diane Swonk, and she made very clear this continuity is going to be there. This is a president that is buffeted, to say the least. And, you know, the real question to me, John, does he make some headlines and make this decision in the next 14 days? Or does he wait? And that's a real point of discussion.
Or does the chairman make the decision for him, Tom? That one could be interesting as well. Chairman Powell is about 30 seconds away, and here's the price action going into that news conference. We look at a little something like this in the equity market. Equities are up 0.1%, all-time highs, and a fifth day of gains on the S&P 500. Your bond market looks a little something like this. You got the $15 billion taper announcement you were looking for. Yields are higher by 4 basis points on 10s, up by 3 basis points on 30, 198 on 30s, 159 on 10s. But the focus of the street is going to be on the front end into the belly of the curve, up 3 basis points on 2s at 48 basis points. Here is the chairman of the Federal Reserve.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery. Given the unprecedented nature of the disruptions related to the pandemic and the reopening of the economy, we remain attentive to risks and will ensure that our policy is well positioned to address the full range of plausible economic outcomes. I will say more about our monetary policy decisions after reviewing recent economic developments. Economic activity expanded at a 6.5% pace in the first half of the year, reflecting progress on vaccinations, the reopening of the economy, and strong policy support.
Are you ready to trade Bitcoin? I'm going to place an order to buy Bitcoin. The price I'm looking to buy, 61,870. If you're looking to trade Bitcoin, here is your chance, 61,870. This is the price I'm looking to buy Bitcoin. Okay, guys. We're quite a bit away, but Bitcoin quite volatile, so we need to place an order and wait for a while until it will reach our level, because first of all, spread different compared to Forex pairs, and another things, the Bitcoin trade a little bit differently than Forex pairs. So if you want to trade, please copy this trade, follow me, and we will close this trade in profit. I'll speak to you later. Stay safe, guys.
In August and September, job gains averaged 280,000 per month, down from an average of about 1 million jobs per month in June and July. The slowdown has been concentrated in sectors most sensitive to the pandemic, including leisure and hospitality and education. The unemployment rate was 4.8% in September. This figure understates the shortfall in employment, particularly as participation in the labor market remains subdued. Some of the softness in participation likely reflects the aging of the population and retirements. But participation for prime-aged individuals also remains well below pre-pandemic levels, in part reflecting factors related to the pandemic, such as caregiving needs and ongoing concerns about the virus. As a result, employers are having difficulties filling job openings. These impediments to labor supply should diminish with further progress on containing the virus, supporting gains in employment and economic activity. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. Despite progress, joblessness continues to fall disproportionately on African Americans and Hispanics. The supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. In particular, bottlenecks and supply chain disruptions are limiting how quickly production can respond to the rebound in demand in the near term. As a result, overall inflation is running well above our 2% longer run goal. Supply constraints have been larger and longer lasting than anticipated. Nonetheless, it remains the case that the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, specifically the effects on supply and demand from the shutdown, the uneven reopening, and the ongoing effects of the virus itself. We understand the difficulties that high inflation poses for individuals and families, particularly those with limited means to absorb higher prices for essentials such as food and transportation. Our tools cannot ease supply constraints. Like most forecasters, we continue to believe that our dynamic economy will adjust to the supply and demand imbalances, and that as it does, inflation will decline to levels much closer to our 2% longer run goal. Of course, it is very difficult to predict the persistence of supply constraints or their effects on inflation. Global supply chains are complex. They will return to normal function, but the timing of that is highly uncertain. We are committed to our longer-run goal of 2% inflation and to having longer-term inflation expectations well anchored at this goal. If we were to see signs that the path of inflation, or longer-term inflation expectations, was moving materially and persistently beyond levels consistent with our goal, we would use our tools to preserve price stability. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability early in the pandemic, and since then have helped foster smooth market functioning and accommodative financial conditions to support the economy. Last December, the committee stated its intention to continue asset purchases at a pace of at least $120 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. At today's meeting, the committee judged that the economy has met this test and decided to begin reducing the pace of its asset purchases. Beginning later this month, we will reduce the monthly pace of our net asset purchases by $10 billion for Treasury securities and $5 billion for agency mortgage-backed securities. We also announced another reduction of this size in the monthly purchase pace starting in mid-December, since that month's purchase schedule will be released by the Federal Reserve Bank of New York prior to our December FOMC meeting. If the economy evolves broadly as expected, we judge that similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by the middle of next year. That said, we are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to support accommodative financial conditions. Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you. We'll go to Nick at the Wall Street Journal.
Hi, Nick Timmeros of the Wall Street Journal. Chair Powell, the markets anticipate you will raise rates once or twice next year. Are they wrong?
So, I would say it this way. We try to focus on what we can control, and that is how to communicate as clearly as possible in this highly uncertain world how we're thinking about the economic outlook and the balance of risks, and how policy will evolve in that case, and also in the cases which are frequent where the economy evolves in unexpected ways. So the focus at this meeting is on tapering asset purchases, not on raising rates. It is time to taper, we think, because the economy has achieved substantial further progress toward our goals, measured from last December. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation. Getting to your question, our baseline expectation is that supply bottlenecks and shortages will persist well into next year, and elevated inflation as well, and that as the pandemic subsides, supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Of course, the timing of that is highly uncertain, but certainly we should see inflation moving down by the second or third quarter. The time for lifting rates and beginning to remove accommodation will depend on the path of the economy. We think we can be patient. If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately. And that's what I would say.
Well, based on, if I could follow up, based on your current outlook for the labor market, do you think it's possible or likely even that maximum employment could be achieved by the second half of next year?
So if you look at the progress that we've made over the course of the last year, if that pace were to continue, then the answer would be yes. I do think that that is possible. Of course, we measure maximum employment based on a wide range of figures, but it's certainly within the realm of possibility.
Thank you.
Thank you. Next, we'll go to Gina at the New York Times.
Hi, Chair Powell. I was wondering if you could detail a little bit how you're thinking about wages at this moment. Obviously, we're seeing strong wage growth, particularly for people in sort of lower income fields. I wonder if you see that as a positive thing or as a potential start to a wage price spiral, and sort of how you sort of delineate those two things.
So wages have been moving up strongly, very strongly. And in particular, I would point to the Employment Compensation Index reading that we got last Friday. Now, in real terms, they had been running a little bit below inflation, so real wages were not really increasing. I think with the ECI reading, it becomes close to maybe not increasing, but close to back to zero in terms of the real increase. So wages moving up, of course, is how standard of living increases over the years for generation upon generation. It's very important, and it's generally a good thing. The concern is a somewhat unusual case where if wages were to be rising persistently and materially above inflation and productivity gains, that could put upward pressure on or downward pressure on margins and cause companies to their employers really to raise prices as a result, and you can find yourself in what we used to call a wage price spiral. We don't have evidence of that yet. Productivity has been very high. The ECI reading is just one reading. Again, if you look back, so we'll be watching this carefully. But I would say that at this point we don't see troubling increases in wages, and we don't expect those to emerge. But we'll be watching carefully.
Next, we'll go to Steve Leisman from CNBC.
Thank you, Mr. Chairman. I wonder if you could perhaps give us your thinking about the trade-offs between inflation and unemployment. You've talked about the shortfall in unemployment or employment relative to before the pandemic, and yet you have inflation, which is affecting everybody. Are we at or close to a point where the risk of inflation is greater than the benefit that you'd for recovering these lost jobs, so that now from a risk management standpoint, it makes sense to move more aggressively on rate hikes? And kind of a related question, the statement today says you'll keep policy accommodative until you hit that 2% inflation target. Our surveys show looking for 5% inflation this year, 3.5% next year. It sure seems like you're on track to modestly or moderately exceed that 2% target. Thanks.
Yeah, so I'm not sure I totally got your first question, but I would say, in fact, could you just quickly, succinctly say your first question again?
Sure. The idea that the trade-off between inflation and unemployment, that you would keep policy accommodative to put this 5 million folks, or find these 5 million jobs again. At the same time, all Americans will be suffering from higher inflation. Is that trade-off worth it, or is it better or smarter to raise rates right now to combat inflation and perhaps not lean so heavily on the employment side of the mandate?
Yeah, so this isn't the traditional Phillips curve situation where there's a direct trade-off, where that's really what we're talking about. The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand meeting those. So I think it's not the classical situation where you have that precise trade-off. But in this situation, we do have a provision in our statement on longer run goals, as you know, that says when those two things are in tension, what we do is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with the mandate. So we used to call that the balanced approach paragraph. We have to think about the amount of the deviation. We have to think about the time it will take. And we have to make policy in a world where the two goals are in tension. It's very difficult. But what it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks particularly now the risk of significantly higher inflation. We see shortages and bottlenecks persisting into next year. We see higher inflation persisting, and we have to be in position to address that risk should it become should it become really a threat should it create a threat of more persistent longer-term inflation? And that's what we think our policy is doing now. It's putting us in a position to be able to address the range of plausible outcomes.
Thank you. Next, we'll go to Colby Smith at the Financial Times.
Thank you. Chair Powell, what are the economic conditions that would perhaps warrant a faster pace of tapering? And I'm wondering how you would also characterize the risks that the Fed may actually need to accelerate that process eventually. Thank you.
So I guess, as I said in my opening remarks, assuming the economy performs broadly as expected, the committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, and we're prepared to deviate from that path if warranted by changes in the economic outlook. So I'm not going to give you a lot more detail on what that might be. Of course, if we do see something like that happening, if it becomes a question, then we'll communicate very transparently and openly about that. But I'm just going to leave it with the words that are in the statement. Sorry, was there a second part?
Yeah, it's just on characterizing the risks that you might actually have to do so later on.
You know, I would just leave you with the words we have here. We are prepared to speed up or slow down the pace of reductions in asset purchases if it's warranted by changes in the economic outlook. And again, if we feel like something like that's happening, then we'll be very transparent about it. We wouldn't want to surprise markets. We'll say, in light of this factor or these factors, we are considering doing this, and then we would either do it or not do it. But I'm not going to start making up examples of what that might be today. Thanks.
Thank you.
Next, we'll go to Rachel Siegel at the Washington Post.
Hi, Chair Powell. Thank you so much for taking our questions. You mentioned at the beginning that the Fed understands the difficulties that high inflation poses for individuals and families, especially those with limited means. What is your message to those families or consumers that are struggling with higher prices right now? And do you feel that your expectations around transitory inflation that message is reaching them? Thank you.
Yeah, so first of all, it is our job to, and we accept responsibility and accountability for inflation in the medium term. We're accountable to Congress and to the American people for maximum employment and price stability. The level of inflation we have right now is not at all consistent with price stability. By the way, we're also not at maximum employment, as I mentioned. So I would want to assure people that we will use our tools as appropriate to get inflation under control. We don't think it's a good time to raise interest rates, though, because we want to see the labor market heal further. And we have very good reason to think that will happen as the Delta variant declines, which it's doing now. As I mentioned, so transitory is a word that people have had different understandings of. For some, it carries a sense of short-lived. And that's there's a real time component measured in months, or let's say. Really, for us, what transitory has meant is that if something is transitory, it will not leave behind it permanently or very persistently higher inflation. So that's why we took a step back from transitory. We said expected to be transitory, first of all, to show uncertainty around that. We've always said that, by the way, in other contexts. We just hadn't done it in the statement. But also to acknowledge, really, that it means different things to different people. And then we added some language to really explain more what we're talking about in paragraph 2 and paragraph 3. We said that supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases. Then we said progress on vaccinations and an easing of supply constraints are expected to support continued gains in economic activity and employment, as well as a reduction in inflation. So we're trying to explain what we mean, and also acknowledging more uncertainty about transitory. So it's become a word that's attracted a lot of attention that maybe is distracting from our message, which we want to be as clear as possible. Ultimately, the only other thing I would say is, look, we understand completely that it's particularly people who are living paycheck to paycheck or seeing higher grocery costs, higher gasoline costs, when the winter comes, higher heating costs for their homes. We understand completely what they're going through, and we will use our tools over time to make sure that that doesn't become a permanent feature of life. Really, that's one of our principal jobs, along with achieving maximum employment, and that's our commitment.
Thank you. We'll go to Chris Rugaber of the Associated Press.
Great. Thank you, Michelle. Thank you, Chair Powell. Well, I wonder if you could update us. You talked about getting back to full employment. And so could you update how you define that? I mean, a few months ago, yourself and other Fed officials talked about getting back to the pre-COVID labor market. There was even hints you might try to do something better than that. Now we hear talk of, as you mentioned, people retiring, and there's talk of not being able to get back all the jobs back because of that and other trends. You did mention the prime age folks. So can you give us some examples of things you're looking at specifically to measure full employment? Will you be looking at prime age employment population ratio, for example? And if so, do you need to see that get back to pre-COVID levels to achieve maximum employment, or is there something short of that would work? Thank you.
Thanks. So maximum employment is it's a broad-based and inclusive goal that's not directly measurable and changes over time due to various factors. You can't specify a specific goal. So it's taking into account quite a broad range of things, and of course, employment levels of employment, participation are part of that. But in addition, there are other measures of what's going on in the labor market, like wages is a key measure of how tight the labor market is. The level of quits, the amount of job openings, the flows in and out of various states. So we look at so many different things, and you make an overall judgment. Now, the temptation at the beginning of the recovery was to look at the data in February of 2020 and say, well, that's the goal, because we didn't know that's what we knew, that we knew that was achievable in a context of low inflation. I think we're we're learning now. We have to be humble about what we know about this economy, which is still very COVID affected, by the way. A lot of what we're seeing in the last 90 days is because of Delta. We were on a path to a very different place. Delta put us on a different path, and we see these things. But so I think we're going to have to, ideally we would see further development of the labor market in a context where there isn't another COVID spike. And then we would be able to see, I think, a lot. We would see how does participation react in that world, in that sort of post-COVID world. Right now, people are staying out of the labor market because of caretaking, because of fear of COVID. To a significant extent. We thought that that schools reopening and elapsing unemployment benefits would produce some sort of additional labor supply. That doesn't seem to have been the case, interestingly. So I think there's room for a whole lot of humility here as we try to think about what maximum employment would be. We're going to have to see some time post-COVID so that we know, or post-Delta anyway, to see what is possible. And I think the learning for those of us who lived through the last cycle is that over time, you can get to places that didn't look possible. Now, what we also have now, though, is we have high inflation. So we have a completely different situation now where we have high inflation, and we have to balance that with what's market. So it's a complicated situation, and I would say we hope to achieve significantly greater clarity about where this economy is going and what the characteristics of the post-pandemic economy are over the first half of next year.
Thanks. We'll go to Howard Schneider at Reuters.
Thanks, and thanks for doing this. So given that answer about employment, I would like to get back to Steve's question a little bit. On a headline basis, just as it's evolved this year, do you feel that the two tests on inflation have been met?
Sorry, the two tests?
The two tests in the statement, the guidance that it has to hit 2% and be on track to moderately be above it for 2%. Has the economy cleared that?
That's a decision for the committee. I would put it to you this way. When we reach maximum employment, when we reach a state where labor market conditions are at maximum employment in the committee's judgment, it's very possible that the inflation test will already be met. we're aware that that language sounds a little out of touch with what's going on, but we're not at maximum employment. When that is the case, we'll look to see whether the inflation test is met, and there's a good chance that it will be if you look at how inflation has evolved in the last year and a half.
So to follow up here, so you're not willing to commit that the current levels of inflation and their persistence have met moderately and for some time. So given that, I mean, how should we render what moderately and moderately over and for some time mean?
What I'm really saying is that question is not before us right now. We had the question on when to taper. We've now answered that question and the speed of it and all that. We have not focused on whether we meet the liftoff test because we don't meet the liftoff test now because we're not at maximum employment. What I'm saying is, given where inflation is and where it's projected to be, let's say we do meet the maximum employment test, then the question for the committee at that time will be, has the inflation test been met? And I don't want to get ahead of the committee on that, but the answer may very well be yes, it's been met. But we're not asking that question today because we're not running the liftoff test. We're not evaluating the liftoff test today. We didn't have that discussion at today's meeting. We did talk about the economy and the development of the economy, but we didn't ask ourselves whether the liftoff test is met because it's clearly not met on the maximum employment side.
Thank you.
Thank you. Let's go to Matthew Boesler at Bloomberg.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So when you're looking at this question of assessing whether or not the U.S. economy is at maximum employment, do you have a framework for making that judgment that is independent of what inflation is doing? And if not, does it kind of complicate that assessment given all of the uncertainty about inflation right now and the inclination to believe that the high inflation we're seeing is not related to capacity utilization in the labor market? Thank you.
So we don't actually define maximum employment as we define it in terms of inflation, but of course there is a connection there. Maximum employment has to be a level that is consistent with stable prices. But that's not really how we think about it. We think about maximum employment as looking at a broad range of things. You can't just look at, unlike inflation, where you can have a number. But with maximum employment, you could be in a situation hypothetically where the unemployment rate is low, but there are many people who are out of the labor force and will come back in, and so you wouldn't really be at maximum employment because there's this group that isn't counted as unemployed. So we look at a range of things, and the thing is, by many measures, we are at a very tight labor market. I mentioned quits and job openings and wages and things like. Many of them are signaling a tight labor market, but the issue is how persistent is that? Because you have people who are held out of the labor market, of their own. They're holding themselves out of the labor market because of caretaking needs or because of fear of COVID or for whatever reason. They're staying out. And it's clear that there are, with tremendous demand for workers and wages moving up, it does seem like we're set up to go back to a higher job creation. So that would suggest that you're not at maximum employment. So at the end of the day, it is a judgment thing. But of course, at the end of the day, it also has to be a level of employment that's consistent with price stability.
And if I could just follow up briefly, you talked a little bit about this possibility that the two goals might be in tension and how you would have to balance those two things. Could you talk a little bit about what the Fed's process for balancing those two goals would be in the event that, say, come next year, you decide there's a serious risk of persistent inflationary pressures despite ongoing employment shortfalls?
Yeah, I mean, again, it's a risk management thing. It's not. I can't reduce it to an equation, but also ultimately, it's about risk management. So you want to be in a position to act to cover the full range of plausible outcomes, not just the base case. And in this case, the risk is skewed. For now, it appears to be skewed toward higher inflation. So we need to be in a position to act in case it becomes necessary to do so or appropriate to do so, and we think we will be. So that's how we're thinking about it. And I think, though, that judgmentally too, it's appropriate to be patient. It's appropriate for us to to see what the labor market and what the economy look like when they heal further. We know that we were on a path to a different place, as I mentioned, when Delta arrived. And Delta stopped job creation. It stopped that transition away from a goods-focused economy where there's excess demand for goods because their services are not available, people are not traveling. That transition itself could help bring inflation down because presumably people would spend a little less on goods while they start spending more on travel and all sorts of travel services and things like that. So that we want to see that healthy process unfold as we decide what the true state of the economy is. And we think it will evolve in a way that will mean lower inflation. Bottlenecks should be abating. We start to see that now with some of them, but overall they haven't gotten better overall, and we're very aware of that. So that's really how we're thinking about it. We're thinking that time will tell us more. In the meantime, we don't think it's time to raise rates now. If we do conclude that it's necessary to do so, then we'll be patient, but we won't hesitate.
Thank you. Let's go to Edward Lawrence at Fox Business.
Thank you, Mr. Chairman, for taking the call. So the Federal Reserve, I want to talk about climate change. The Federal Reserve released a statement today, says the Federal Reserve supports the efforts to identify key issues and potential solutions for the climate-related challenges most relevant to central banks and supervisory outcomes. Is this putting us on the path to regulate what banks can offer loans on or invest in, like coal plants or fossil fuels?
So that's not a decision for bank regulators or for any agency. That's a decision for elected representatives. So we feel that any role that we have, and we do think we have a role in climate change, it relates to our existing mandates. And our existing mandates are really prudential regulation of financial institutions. We expect them, and the public will expect us to expect them to understand and be in a position to manage their risks. So that's physical risk and it's transition risk for climate. And by the way, the large financial institutions are doing this already, and we think that's right within our mandate. There's also a financial stability question, the overall stability of the financial system, and so from that standpoint, we can do research. We can try to help understand what will the pathways be through which climate change affects the economy, both physical risk and transition risk. That's what we can do, and that's what we will do, and we'll do it well within the frame of our existing mandates. We'll do it well. We're not the people who will decide the national strategy on climate change. That has to be elected people, and not so much us. But we feel like we have that narrow mandate, and we will do it well.
Thank you.
Great. Thank you. Victoria Guida at Politico.
Hi, Chair Powell. So the Fed recently announced that there's going to be new conflict of interest rules for investments by Fed officials. And this follows, obviously, the resignation of 2 regional Fed presidents. And I'm just wondering, do you think that there's more that you will need to do to rebuild the credibility of the Fed, such as, requiring officials to put their assets in blind trusts? And also, if you could speak to whether you have any concerns that any rules or laws were broken by Fed officials. Thank you.
So let me just say that this system, the ethics system we had in place, had been in place for decades, and had, as far as we know, served us well. And then that was no longer the case. And so we had no moment of denial about that. As a group, we stepped in and we took the actions that we took. Within one FOMC cycle, we announced a new set of rules to try to put us back where we need to be, which is we need to have the complete trust of the American people that we're working in their interest all the time. Absolutely critical to our work, as it is for any government agency. And I feel like this called that into question. So we reacted. I would characterize it strongly and forcefully. If there were other things that we could do that were reasonable, we would certainly do them. So you asked about blind trusts. The overall authority for ethics around these issues in the federal government is the Office of Government Ethics, OGE, and they have a long-held position which is not favorable to blind trusts. They do not encourage them. They don't think they're effective. They think they're cumbersome, and they think there are better ways to get at the things that need to be done, and those are the things that we're actually doing. So I don't know that there are any blind trusts for that reason, because they're the regulator. They say this on their website if you look. In terms of laws broken, I asked the Inspector General to look to see whether there were rules broken and whether there were laws broken, and I won't speculate on that. But that is with the Inspector General now, and of course, out of my hands.
Thank you. We'll go to Mike McKee at Bloomberg.
Mr. Chairman, the critics of your patience policy argue that given the long and variable lags with which monetary policy works, that you are likely to end up, given inflation, by having to raise rates faster and farther than you would have liked, and therefore send the economy into recession. Given the fact that basically your forecast has been chasing inflation over the last year, and now you're talking about it not coming down till the second or third quarter, why would they be wrong in thinking that?
Well, so let me say what's happened, and we're very, very straightforward about it, is that inflation has come in higher than expected, and bottlenecks have been more persistent and more prevalent. We see that just like everybody else does, and we see that they're now on track to persist well into next year. That was not expected by us, not expected by other macro forecasters. Now, let me say, it's difficult enough to just forecast the economy in normal times. When you're talking about, global supply chains in turmoil, it's a whole different thing. And you're talking about a pandemic that's holding people out of the labor force for reasons that we can sample, but we don't have a lot of experience with this. So it's very, very difficult to forecast and not easy to set policy. So we have to set policy, though. So that's what we're doing. And, so to look at your question this way, I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes. And that's what we need to do. I do think it would be premature to raise rates today. That's not, I don't think that's controversial. Certainly, I don't know anyone arguing for that today. And the reason is that there's still ground to cover to get to maximum employment. And we don't want to stop that when there's good reason to think. There's still good reason to think, although it's been delayed. Clearly, there's good reason to think that the economy will reopen, particularly if we do get past, significant outbreaks of COVID. That's when we're really going to see what the characteristics of the labor market are. And, I think, the bottlenecks that we're seeing in global supply chains around goods, and frankly now at our own domestic ports, because demand is stronger than the capacity of those ports, those things are going to work themselves out. We have a flexible economy. It'll take some time, but, the experts managed to create a vaccine faster than certainly than I expected, and I think this stuff will work itself out over the course of next year. That is my baseline understanding, and that's very widely held among people. But we are prepared for different eventualities, and we will use our tools to achieve price stability and maximum employment. And we're going to let the data lead us to where we need to go. Our policy will adapt, and has already adapted to the changing understanding of inflation and of bottlenecks and the whole supply side story, which is also partly a demand story. So our policy will continue to adapt as is appropriate.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking our questions. So you announced that the Fed is going to taper at a rate of starting at $15 billion a month, and that's more than twice the pace of the last taper. So why are you tapering faster this time?
The economy is in quite a different place than when we tapered back in, I guess it was 2013. We were much farther away from maximum employment. Inflation was much lower. This is an economy where demand is very, very strong, and job openings substantially exceed the number of unemployed people. So the need for further stimulus is far less than it was in 2013, where we still had quite a ways to go. I mean, after we began that taper, it was still many years before we reached what I would characterize as conditions consistent with maximum employment, let alone price stability. So this is quite a different situation. And, the committee unanimously felt today that we had met the test that we'd articulated, and this was appropriate. And this is faster than what people had expected 6 months ago. It's earlier and faster. And that's because as I mentioned, our policy has been adapting to the situation as it evolves, as it's clarifying itself. And that's partly because we see inflation coming in higher.
Thank you. Let's go to Mike Derby.
Yeah, thank you for taking my question. I wonder if the Fed has given any thoughts yet to the end game for the balance sheet in terms of, once you get the taper process complete, will you hold the balance sheet steady, or will you allow it to start passively winding down? And then in a related question, do you have any greater insight into what Fed bond buying actually does for the economy in terms of its economic impact? Have you been able to, measure it or quantify it in any fashion? Because I'm sure there's often been questions about what is bond buying actually doing to help the economy.
Sure. So in terms of the balance sheet, those questions that you mentioned, we haven't gone back to them. Now that we've tapered, I expect that that's exactly what we'll do in coming meetings, and we'll do it in an orderly fashion. And we'll talk about reinvestment and all those things. And we don't have to make decisions on those yet. But typically when we're doing a new subject like that, we'll have a series of briefings and discussions, and that's what we will now begin to do. In terms of the effect of asset purchases on the economy, so there's a tremendous amount of research and scholarship on this, and you can kind of you can find different people coming out with different views, but I would say the most mainstream view would be that you're at the effective lower bound. So how do you affect longer-term rates? There are two ways. One, you can't lower rates. Let's say you can't lower rates any further, hypothetically. So you can give forward guidance. You can say we're going to keep the rates low for a period of time, either a specific period until certain conditions are met. The markets will do the math, and that'll have an effect on longer-term borrowings, even 10, 30 years out, kind of thing. So that's one thing. The other thing you can do is you just go buy those securities, buy longer-term securities. That will drive down longer-term rates and hold them lower. And rates right across the rate spectrum matter for borrowers. So lower rates encourage more borrowing, encourage more economic activity. People that you can service your debt, you have more free cash flow. It's not different from what we do at the short end. So that was discussed long before anybody did it. That was, I think, Milton Friedman said that was what you could do if you were pinned at the lower bound many, many years ago. So anyway, that's how it's supposed to work. And it's quite hard to be precise about these things because you only have one economy and you can't run two different economies right next to each other and do a scientific experiment. But most of the findings are that it does support economic activity in the way that you would expect, which is to say, at the margin, more economic activity with lower rates, which is why we do what we do. More accommodative financial conditions lead to more economic activity over time with a lag. So I think that's the main finding I would say on QE.
Thank you.
Thank you. We're going to go to Paul LaMonica at CNN.
Chair Powell, you've addressed already questions about the stock purchases that took place from some of the regional Fed presidents and, addressing the American people to make sure that they can trust the Fed. I was wondering also, in light of the fact that, we now have questions about your own future, whether or not President Biden will nominate you for a second term, what would you say to the president and to senators that potentially, will be voting on a renomination about this specifically with regards to your future as Fed chair for a possible second term?
So I will answer your question, Paul, but I'm not going to have any comment whatsoever on the renomination process at all. I will say, though, that I have briefed administration officials and I've briefed people on Capitol Hill in detail about what we did and why we did it, and seeking their feedback, getting their reaction. But this is part of my job. Congress has oversight over over the Fed, and we take that very seriously. So if you're on our one of the two committees that has oversight over us, then I'm in regular contact with you probably. And, when something like this comes up, I'm on the phone, I'm offering to meet with you and explain it to you and answer your questions and identify any concerns people might have. That's just part of my job. So I do that. I don't talk about particular conversations, but you can assume I'll always do that. And I certainly did it in this case.
Thank you.
Thank you. Let's go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the supplementary leverage ratio. Is the Fed still planning on seeking comment on ways to permanently adjust that? And how concerned are you ultimately about banks' willingness to intermediate in the Treasury markets without a permanent fix?
So I don't have anything for you on supplemental leverage ratio right now. We are looking at ways to, if there are ways we can address liquidity issues through that channel. We also have there's a working group headed by Treasury about over Treasury markets and what happened in the acute phase of the pandemic and what structural things may need to be done. So that would be part of that work stream. And I know that there's a lot going on. I'm not sure when that report will be out, but so it's work underway. That's one of the many issues that are part of that, along with things like central clearing of treasuries, greater central clearing, and many other ideas. It's important that we have a liquid treasury market. It's a huge public benefit that we do, and I think we need to do those things that enable that, while also assuring safety and soundness of our largest financial institutions, who tend to be the main dealers. So we have to make sure that's always a first order concern as well.
Thank you.
Thank you. Let's go to Brian Chung at Yahoo Finance.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. So just to expand on the ethics conversation, you talked about how you engaged with people on Capitol Hill and in the administration. You talked about what you've done already, but I'm just wondering if you could take a step back and just assess whether or not there was reputational damage as a result of that, either from the public's view or from the financial community's view of the Federal Reserve's independence. And then secondly, do you look back on the whole episode and have thoughts on your individual responsibility in preventing something like this from having happened?
So I think it's too soon to say what the reputational damage is. I think from the very beginning, my reaction was we need to deal with this straightforwardly, transparently, and forcefully, and that's what we're going to do. I mean, it means everything to me that we do whatever it takes to make sure that nothing like this happens again. And I like to think we've made a real good start on that. If you think about it, you cannot execute a trade unless it's pre-cleared. And then you have to say execute. It's not even a trade. Really, there's no trading going on. This is for investment and getting liquidity for life's expenses. But you then have to wait 45 days to actually execute that sale or purchase. So I think it's a pretty good system. We'll always be looking to make it better. So in terms of our independence, Look, I think we will address this, and I think we have, and I like to think it's enough, but it's going to, we're just beginning to implement it. We have to write the rules, which we're doing, as quickly as possible. We need more people. We're going to have to resource this much more significantly here at the board. And also, we're going to need appropriate technology because, the Fed has system has more than 30,000 employees. Not all of them, far fewer of them will be covered by this. But the senior officers who will be covered by this will have to have technology access, and it's going to have to work efficiently. So there's a lot of work to do to implement it. Again, I would just say. This system has been in place for decades, and it was in place when I took over. It was in place for at least the last 3 or 4 chairs, and it was what it was, and it proved to have weaknesses in it. And part of that was that it wasn't uniformly enforced across the system. I'm a big believer in the value of the Federal Reserve System and the reserve banks, but you had 12 different ethics officers at 12 different banks, and you had ethics people here, and compliance wasn't all exactly the same. It was a little bit different and uneven, And also the rules were, we didn't we didn't imagine the problems that happened. And they may have actually been, I don't know this, but they may actually have been in compliance with the specifics of our rules. They were clearly not in compliance with the part of our rules that said, don't do anything that would create a bad appearance. I mean, that's clear. This was a bad appearance. So anyway, what can we do? We are where we are. It happened, and we just have to deal with it forthrightly and transparency and own it and step up to this, meet this moment. I'm totally committed to doing that. And again, if there are better ideas, I'd love to hear them. But I think I think we have so far made a good start.
When you say you spoke with administration officials, did that include the president?
I'm not going to answer who I spoke to at all. I'm not going to give you any names. So don't take that as a yes or a no. I'm just not going to start down that road.
Okay, thank you. We're going to go to Jeff Cox for the last question.
Yeah, thank you. Chair, I just want to dig a little bit deeper on employment. We've seen what's been called the Great Resignation, with folks leaving their jobs in record numbers. Is there any feeling there that maybe you've been accused of fighting the last war, that perhaps the labor dynamics have changed in the post-COVID environment, and that full employment may not look like what it looked like before?
Yeah, so what's happening is people are leaving their jobs. They're quitting their jobs in all-time high numbers, but in many cases going back into employment and getting higher wages. So a lot of the higher wages you're seeing are for job switchers rather than incumbents. So that's a sign of a really strong labor market, as opposed to people just running off and quitting. There have also been, there are a significant number of retirements, and we'll just have to see what that means. So toward the end of the last cycle, which was the longest in our recorded economic history, we did see labor force participation moving up well above what economists estimate was the trend. And part of that was people staying in the labor force older and just not retiring at the rates they were expected to retire. So maybe this was just catch up on that. I believe that over time, you won't know you won't know what can happen with labor force participation in advance, and you're just going to have to give it some time, because we saw that over and over again. There are things that we can say, this is where the limit is. Labor force participation is a much more flexible subject for me, and so I do think we need to be humble about what the limits are of labor force participation. But we expect labor force participation to pick up. We don't know the pace at which it will do so. So in terms of full employment, as I discussed earlier, I think at the very beginning of the recovery, the natural thing to do was to look back at labor market conditions in February of 2010, at the end of the longest expansion in our history. It was so much to like about that labor market, really historically good labor market, never perfect, but a good labor market. We're in a different world now. It's just very different. The pandemic recession was the deepest, and the recovery has been the fastest. And wages didn't really go down, and real incomes were more than fully replaced by fiscal policy. All of this is completely unusual. An economy where inflation was driven by services is now inflation where all the inflation is in goods, which have had negative inflation for a quarter century. So you ask about full employment, I think we have to, I'm very open to the thought that it's going to be an empirical question of where it is located, and we're just going to learn more and more. I mean, one thing we'll learn, I hope we'll learn in the near term, is once the Delta variant really does continue to decline, what's going to happen to employment? Are we going to start to see over the winter, significant increases in jobs again? If you look back, the 3, 6, and 9-month average job creation is between 550,000 and 600,000. So if you think of that as a stronger, you don't have to think back to the million job months of June and July. You can just think, okay.
points. Bear in mind that earlier in the last week, we have breached 50 basis points on a 2-year, right now, 47. Just short of 160 on 10s, up 4 basis points on the day. On 30s, up 4 as well, just short of 2% at 199. And in foreign exchange, the dollar just a little weaker here, just a little bit softer. Your dollar index is negative, a little more than 0.1%. Tom Keene, the chairman of the Federal Reserve, stepping back from the word transitory, but clinging to the underlying theory. The leader of the Fed, quite clearly, wants to remain patient.
Fascinating, John. And one thing I want to say is he gets better and better. He's very different from the press conferences that we saw with the first of Chairman Powell. I love what Michael Darda just publishes on this, John. He was fired up today and continues further. Macro blather, quote, paleo-Keynesian rubbish. And the chairman today pushed against paleo-Keynesian rubbish.
He called it the dovish taper. It's pretty clear that the chairman of the Fed, Lisa, wants to sound credible about acting if he has to, without sounding impatient about moving anytime soon. Do you think he was successful? The market seems to say yes.
Operation Do No Harm, Operation Don't Budge Anything seems to have worked pretty darn well. And if you take a look at equities at near or at record highs, I guess that people who want him to just perpetuate the risk on feel will be happy. The issue is he wants patience. And I do think that the conversation going forward will be how much patience can he afford to have when the balance of risks is getting more and more weighted toward the potential overshoot and what that means.
He did something very early on in this news conference that a lot of people picked up on that I thought was really interesting as well. And shout out to a Fed watcher that I have a ton of respect for, Tim Dewey. He pointed it out as well. He offered us a little bit of a timeline here. Take a listen to what he had to say at the very beginning of this news conference.
Supply chain bottlenecks will abate and job growth will move back up. And as that happens, inflation will decline from today's elevated levels. Certainly, we should see inflation moving down by the second or third quarter. If a response is called for, we will not hesitate. So what I will tell you is we're watching carefully to see whether the economy evolves in line with our expectations, and policy will adapt appropriately.
It's all about the timeline now, the reaction function. There's a deep understanding of that, Tom. And the second and third quarter. Look, whatever you think about the T word, the chairman of the Fed has just told you now, the second and third quarter is a key test for this Federal Reserve, Tom. That's the timeline. That's the timeline he mentioned at the start of this news conference.
He reestablished the timeline today, John. I thought it was very, very nuanced. I thought, frankly, there were some important questions there, and also important, the prepared comments he made when he looks down. For those of you on radio, there's two answers. One is where he's talking, like near the end, and the other's prepared comments that message their message, John, as they go to the data, including Friday's jobs report.
Lisa, that wasn't lost on you either. That first question, he started flipping through the pages pretty quickly to find the answer to that one.
He was going to read that verbatim. And interesting that it had very similar tone to ECB President Christine Lagarde, basically saying, I'm not going to necessarily say the market's wrong. That's not what we're seeing, but we will adjust as it seems fit. What I thought was interesting, that was pretty soft pushback. The markets didn't really respond. To me, that says everything. Those who believe that inflation is hotter than expected continue to believe that. Those who buy the Fed continue to buy that.
Did you like what happened when Mike McKee finally got a question? Tom Keene,
let's stop here, John.
Maybe.
There's really important questions asked. You and I have talked often about the difference between an ECB presser and a Fed presser. And then there's the McKee question.
The McKee question. Michael McKee
every time
joins us now. Mike McKee, I have to say, if President Lagarde and Governor Bailey are watching this, they're probably happy that you're not in those news conferences. Can you walk me through what you learned, sir, in the last hour?
Well, I think what we learned is that the Fed is getting a little bit more humble about its forecasting abilities. They did not put a timeline on when they thought inflation would go down, other than in broad strokes 2022 previously. Now they're saying second or third quarter, but they had left the impression in the markets back in the summertime that we were going to see inflation come down rather quickly, that transitory was an actual thing. Now they're saying it's expected to be transitory, and the chairman raises the possibility we could go into the third quarter with inflation elevated. The other interesting thing here is that they said they're going to start tapering $15 billion a month in November and in December. but they did not put any numbers on January going forward from there. They said it appears likely that we would do that in the same numbers, but they've left themselves an out now. If inflation doesn't start to move down a little bit, doesn't start to ease off some, then they could easily speed up the taper, and if the economy doesn't recover from its third quarter swoon, they could easily slow it down.
Mike, we're among friends and family. Why did Chairman Powell pause over your question? What forced him to stumble there? Seriously.
Well, I suspect the Fed is concerned about the perception that they could be behind the curve, because then the market starts to take its own actions because they don't want to wait for the Fed. And so he wanted to make it clear that the Fed is aware of the possibility that they could be wrong. And he went on at great length in his answer to me and other people about how this economy has changed. It presents unique forecasting difficulties, and they are as I said earlier, humble about whether they can be accurate or not, but they're doing their best.
Michael McKee, thank you so much, and please stay with us
Mike.
as well. Right now, we're going to finish incredibly strong. I believe Michael Ferroli to join us here in a bit. Right now, Jeffrey Rosenberg with BlackRock, portfolio manager of the Systematic Multi-Strategy Fund. And what I love about him is the mathiness of his Carnegie Mellon. Does the Fed know the math? Do they know the reaction function, Jeff Rosenberg?
Well, I think it's the other part of your question, Tom, is does the market know the Fed's reaction function? And I think we got, a little bit of that today, another reiteration, and a pretty successful one, as you were talking about a few minutes ago, of kind of taking out the hawkish fear. This is a bond market that has seen globally some pretty dramatic changes in central bank policies. You look at what happened in the RBA, you look at Governor Bailey and the BOE and the BOC, some pretty dramatic reactions to inflation. And that had spilled over into market expectations for the Fed. And I think at least for a moment today, the Fed had, along with the ECB, have tried to, kind of hold the ground there. But you have a very different global backdrop here where you have some central banks, historically more wedded only to the inflation mandate, really reacting to this inflation and its possibility of not being transitory. And here you have the Fed and the ECB kind of holding firm. That's going to be the tension I think we see for a while. Maybe it'll show back up in the markets on Friday, because labor markets and labor market healing are going to be the key kind of determinant of that timing of liftoff. And I think that's where the topic is clearly going to be the focus.
Jeff, as you know, disagreeing with the Federal Reserve is a sport on Wall Street. There are a couple of ways of disagreeing with the Federal Reserve, though. You can question their reaction function or question their forecasts. The former is a lot higher bar, I think, than the latter. So let's talk about the latter. They've basically told you now how important the second and third quarter is. Now, we can have a conversation about their forecast. They believe that through second quarter, through third quarter of next year, inflation declines, and perhaps markedly. Do you take the other side of that and validate where the rates market has been priced over the last month or so?
No, I mean, a lot of forecasts have inflation coming back down around that time period. So, it's not necessarily out of consensus to say that, second quarter, third quarter. Maybe what was surprising, and maybe in hindsight they may regret that because the forecasts have to change, they have to evolve. But, what we're talking about here is not necessarily, dramatic declines in inflation, but just that inflation stops going up. And particularly that broad-based measures or trimmed-based measures of inflation outside of these categories. I think the Fed, when they were talking about transitory, they were talking about these clear COVID-impacted sectors. And what they got wrong was that it did spread to broader-based measures. And it's really seeing the halt in the increase in those broader-based measures that I think the Fed and the forecasts are talking about that will take some of the froth off the boil of inflation fears. Now, of course, if that doesn't happen, then there's a forecast error. There's something structurally going on, and the Fed may have to react. Whether or not they will and to what extent still remains to be a debate. But I think the forecasting that inflation will stop going up at this rate isn't really that much out of line with market consensus.
The chairman sounding a whole lot more humble about the future. President Lagarde coming out with some really strong pushback in the last minute or so in an interview with the broadcaster, Lisa, saying 22 is off the chart. in respect to interest rates. So that's some sizable pushback from ECB President Christine Lagarde. And I just wonder if this equity market just really gets the joke right now.
Yeah.
Small caps up by 1.9%, the S&P at a record high, up 0.5%. The Fed's telling you this: demand's really strong, and inflation isn't going to encourage us to move in anytime soon and hike interest rates. That, Lisa, is a fertile environment to keep buying risk.
And this is the key question. Is the ECB in such a different position than the Federal Reserve that we cannot really draw comparisons to when they lift off and what they message? And I wonder, Jeff, from your perspective, if you think that that's what was messaged with Jay Powell today, giving basically a very similar pushback to market expectations as ECB President Christine Lagarde, and not really getting much of a reaction at all.
Yeah, and you know, for the Fed, they're in a different position with regards to the shift in flexible average inflation targeting, and that gives them more, as is in the word, more flexibility, but it's also the shift in kind of broad-based and inclusive labor markets. And that is an important shift in terms of the balancing of the dual mandate between labor market gains and inflation costs, that in my assessment, you know, tilts it a little bit more towards labor markets. It's also a function of kind of public policy and public willingness to absorb the higher costs of inflation, and how those higher costs of inflation are really a distributional challenge. It doesn't affect the overall economy in an equal fashion. And that has a great impact in terms of how the policy trade-offs between employment and inflation will ultimately be decided if we get to that point of a real significant persistence in inflation.
Jeffrey Rosenberg, thank you so much with BlackRock. Right now, NASDAQ up 0.9%, some real strength of the tape. The VIX doesn't go to a 14 level, but we're watching that carefully. We are as good as our guests, and we love on this day of a long Bloomberg surveillance to finish strong with Michael Ferroli with JP Morgan. His work has been definitive. His weekly prospects Friday late is the read of the weekend, or at least the beginning read, I should say, of the weekend. Michael Ferroli, this week you were strong with Bruce Kasman. It was on wage growth, and it was also on savings. How does this Fed adapt to the diminished savings of this unique boom economy, this unique pandemic?
So I think on the wage growth thing, I think that's what's interesting here is what's really going to be operative for liftoff is clearly full employment. And what I was most interested in listening to Chair Powell today was his, you know, continued modest evolution toward a bit more, I guess, pessimism on the supply side of labor supply, which is to say, not so sure the participation rate is going to bounce all the way back to where it was in early 2020. Still, he's holding out hope that, you know, we're going to see some pickup in participation. So the nuances there, I thought, were what I was most interested in thinking about the next stage of the normalization of Fed policy, which really just comes down to when they judge that we've actually reached full employment.
Michael, this is so important. Your view on where the participation rate is going ultimately spells out what you think about this labor market right now. Is there a ton of slack, or is it tight? What's your view on that now?
So I tend to agree with the chair that we are not at full employment, that the tightness in some measures like the vacancy to unemployment ratio, that some of that is, it's not necessarily going to persist if some of these people come back into the labor market because of, you know, Delta issues fading. You know, it's interesting, the chair a number of times said, well, now that Delta issues are fading, we'll soon get a cleaner look at both the inflation picture, the employment picture, the overall economic picture. But, you know, now we're starting to see some hints of seasonality in the virus and a little bit of a pickup in some of the northern states. I'm not so confident that we're going to get a clean picture of the economy in the next couple of months, even though the chair seems to think has a little more optimism in that regard than I do. But I guess I would say that in terms of full employment, I don't think we're quite there yet, but certainly a lot of pollution in the figures due to the virus issues.
Michael, I was going to ask you about Friday's jobs report, but before I even ask you about the details and what you're looking for to edify your view, is it really something to watch? Can you make a decision around this labor market report, or is it still too noisy based on what you're saying?
So it's been noisy for a year and a half, but you have to make judgments at a certain point. I will be very interested, and you know, the chair mentioned this today as well, that we recently had school, you know, the back to school happen. We recently had the end of the unemployment benefits. It may have been too early to see that in the September jobs report. But I'll be very interested to see if there are any hints of that actually having any impact in the October numbers we get on Friday. But look, you never want to take one jobs report in isolation. And I do think there still are factors that are going to muddy it, but I wouldn't say we discard it for that reason by any stretch of the imagination.
I'll let the equity team over at JP Morgan do the stock stuff, Michael, but I do want to ask you a question related to it. This is a NASDAQ right now up for an 8th straight session. It's an S&P 500 at an all-time high. And for the reasons I described a few minutes ago, there's a reason to believe this is very bullish for risk assets. The idea being that demand will remain hot, that inflation won't be robust enough, broad enough for the Fed to come in too early. I wonder from your perspective whether higher prices starts to hurt demand increasingly, materially going into next year. Do you see that evolving in some way? Do you see evidence of it now, Michael?
Well, certainly we saw evidence of it in the third quarter, right? Nominal demand was pretty decent, but once you took account of price increases, the real increase in output and demand was pretty paltry. So we're already seeing that. I would suspect as we get into next year that starts to fade. I think yesterday we saw some, maybe the faintest of green shoots in the auto data, which showed a little bit of a pickup in sales, a little bit of a pickup in inventories. If that can continue for the next couple of months, again, echoing the chair today, the auto industry has been so important to both the price and the activity data that things like that, if that picks up, I do think. Go ahead.
I got to rip up the script here, Michael, because this is really important and goes to your weekly prospects. Do we, or the chair, do we have a true understanding of the American economy when you look at auto manufacturing issues, supply issues, inventory surprises, and odd net exports? Do we really know where we are?
Well, we never know perfectly, and I think the chair showed a good amount of humility, which was appropriate. And I think, look, the past year and a half have been exceptionally difficult. But I do think we're getting a little bit of a better picture here of where we are. Certainly better than we had been a year ago. But I mean, Tom, this is an imperfect science, and particularly when we're trying to do it in real time with data that gets revised. And so, nonetheless, that's what we're operating with. I do think things are certainly improving in terms of activity data as we head into the fourth quarter. Yep. The inflation's more in question.
Michael, love catching up with you. You know that. Thanks for being with us. Michael Ferrari there, Chief Economist at JP Morgan. Tom Keene, all-time highs in this equity market off the back of this. Bottom line, record high, record high, record high.
And John, let's dovetail this to get to tomorrow morning where we will have Bloomberg surveillance onto the jobs day as well. I'm sorry, John, equities melt up. VIX just hits 14.99. And as a general statement, John, bonds do nothing.
Did you almost call me Bond there, Tom?
Yeah. I didn't call you
almost
bonds.
happened.
No, it's because you look like Daniel Craig.
John,
I was like Daniel Craig.
Okay, slow down. Lisa, let's not lose this moment. This Federal Reserve chair started this year with a T word and has pushed it all the way out to the third quarter of 2022.
The issue that I think is the most compelling from this whole moment is that he said we need to have patience because the labor market is just that confusing right now. The problem is, again, it goes to this core issue, where are the balance of risks?
Yep.
Is it potentially more damaging to the economy to allow an inflation overshoot and then respond to it? Or is it more damaging to curtail an economic recovery too early? That is the debate going forward.
And lessons about humility, Lisa. Tom, reflect on that going into tomorrow, about being humble.
Oh, boy.
Humble. Looking forward to the coverage through the market close a little bit later. Let's bring in Romain for more. What's coming up, Romain?
All right, we are cutting you down to the close. Record highs across the board on the indices. A lot of individual record highs as well. AMD, Microsoft, just to name a few. PepsiCo as well. A lot of the consumers' discretionary names. That's your leader on the day. In fact, this has been your leader here for the past month. Tom, you mentioned the melt up here. Ed Yardeni, of course, had a great note out prior to the Fed announcement, talked about this melt up. He said, look, this latest leg of the bull market has been much more about earnings and a lot less about Fed support. Ed Yardeni going to be joining the program a little bit later. Kathy Bastanic also going to be joining as well.
You're selling it nice, Romain. Yeah. Sell me the melt up in small cap that I observed.
The melt up here is 93% earnings beat when it comes to bank stocks, 90% beat when it comes to technology stocks, 80+% beats when it pretty much comes to everything else here. Basically, if you're in anything other than real estate utilities, you're getting game here, and you're getting it from earnings, not the Fed.
Romain, thank you. Looking forward to the program through the close. Tom Keene, All-time highs to wrap things up for us. Are you going to be with us tomorrow morning?
I'm looking for an entry point. I got to go readjust, reset the
building?
triple leverage.
Couple of beverages, a little bit later.
Just a couple.
Just to add to the couple that we had before the show.
36,000. There ought to be a book about that.
I think there was a book, Tom. I think there was a book. From New York City this morning. Good morning.
Good morning.
Did you like that? That was for you guys. That was for you. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. We're looking at records for the Dow, the S&P, NASDAQ, Russell 2000, stocks surging today. Federal Reserve says it will begin winding down its monthly asset purchases later this month at a pace of $15 billion a month, while expressing less certainty that the jump in inflation will prove temporary. Here's Fed Chair Jay Powell. You heard him live here on Bloomberg Radio.
Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery.
S&P up now by 30 points. That is a gain of 0.7%, extending its year-to-date gain now to 24.1%. The Dow up 109, up 0.3%. NASDAQ rallying 164 points, up 1%, bringing its year-to-date gain to 22.7%. Russell 2000 up 1.9% today. NASDAQ 100 index up by 1.1%. 10-year on this Fed Wednesday, 1.57%. 10-year down 7/30 seconds. Spot gold down $13 the ounce, down 0.7%. Bitcoin down 0.2%. West Texas Intermediate crude down 5%. Again, recapping stocks at records. S&P up 31 points now, up 0.7%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, the Fed chief has come and spoken, and markets seem to be okay with it. In fact, we're seeing records on those major equity averages here, Charlie. We are at our highs of the session when it comes to the S&P Dow and the NASDAQ. Yields moved down, then they moved up. It seems like stocks up, treasuries down, yields up. We're okay. Everything is awesome.
Right. My big takeaway is that Jay Powell and the Federal Reserve have done a really good job communicating.
Yeah.
Because look at the way markets are reacting.
Well, there's one thing he said specifically when it comes to pace, and he says, we will not surprise the markets on a change in pace. If anything we have learned about this Fed in particular, Jay Powell, of course, at the helm of that Fed, is that they are going to feed information to the markets. There is nothing that he necessarily wants to surprise, but he stands ready to act and change policy direction if needed and as warranted by the economy. All right, let's see what our guest has to say as we count you down to the closing bell on this Fed Wednesday. Hillary Kramer is back with us, President and Chief Investment Officer at A&G Capital Research. She joins us once again on the phone in New York City. Hillary, he does seem to be among the great communicators when it comes to Fed policy. What is it about what we heard from Fed Chief Jay Powell and that Fed decision? We only have one more left in this year of 2021. What stands out for you?
That it's a dangerous policy we're in.
Why?
Very dangerous. It's dangerous because Powell wants to wait for full employment before he starts raising rates. So in the meantime, Carol, we have the housing market. It's like a casino with so much speculation. A few people say, "Hey, Hillary, why is gold not going up?" And I think of crypto. Of course, it's the opposite of gold, but an alternative for those that are fearful that prices are going, through the roof. And although Powell did exactly what we expect, right, we're going to sustain a rally. There's no question about that because we're getting ready to close the books, end of year. And look, we're tapering way too slowly. That's another takeaway for me. Like, there's no need to keep buying 120 billion a month. I mean, now we're going to 105 billion a month, 90, and then in June we'll start.
Right.
We'll be completely done, and the Fed will be done buying bonds and
So,
to keep rates low.
Hillary,
So,
we don't have a ton of time, so I want to make sure we drill into what you're saying here. What specifically about the Fed's policy is dangerous to you right now?
It's causing a speculation. Money is free. Money is free. It's phony money. Look at the supply chain disruptions, right? Just look at those. All of that has to do with, phony interest rates and a Fed policy that has everybody buying, for their home, for their life, for their car.
Wait. You're saying an interest rate, low rate is what's causing supply disruptions. Isn't it a case of just the supply chains just aren't actually working, whether it's not enough people in the ports, not enough people at work to make it all happen? We also do have incredible demand because we talk about this constantly about consumption. It is out there big time. And whether people are, whether it's corporate buying, individual buying, kind of buying in advance, concerned about running out of supplies, it's kind of this weird little cycle. But isn't it because of that and not necessarily cheap money?
But that's what you just said. In my opinion, Carol, is that it actually is from cheap money. It's all of this demand. This demand has created this supply chain disruption. Why is there so much demand out there? Because rates are so low. Because money is so incredibly cheap. This policy has people buying, just buying homes. Look at the real estate market.
But if you try to go buy a car right now, you can't actually buy a car.
That's
right? So at some point,
everyone has so much money and money so cheap, they're all buying. Now, of course, we also know part of the problem has to do with labor shortages, and that's why there's a supply chain disruption. Why do we have a labor shortage? Because people want to be paid more, because everything costs more, and they're looking for their wages to go up, which they're starting to, and eventually we're going to have a cycle of wage inflation. Now, I'm all for someone who works at Walmart getting $25 an hour instead of $17, but still it begs the question, what's going on here? People are saying, I'm not going to bother working. It doesn't make sense, plus the entitlements, they have gone, they pretty much have tapered off to nothing. But
so then why aren't people back at work? I mean, that's the thing we have to kind of figure out. And there's been some really smart conversations. Tim and I have talked about this even off air. It's just, you maybe have couples making decisions that can afford to say, maybe you're not going to go back to work because we don't want to go back to the way life was, or we can afford to do without some things, or kind of figuring out different ways of doing things. Maybe there is something, and it sounds like the Fed and Jay Powell in particular, one of the things that really stuck out for me is he said, we have to be humble about what we know about this economy. I also read into that what we don't know about this economy. He said it's still Delta dependent, and that puts us on a new path. We really don't know what our economy will truly be, especially when it comes to the labor market on the other side of this pandemic.
We don't know what the labor market will look like, but we do know one aspect of it, which is that people who are working are going to demand a lot more money. I mean, they have to. Let's go back to, let's say, October 21st. That's a great example. Chipotle's earnings, FactSet said they'd be up 68%, right? They were up 155%. That's beside the point. What's really important? Labor costs spiked 24%. Food and beverage rose. Those expenses rose 14%. So at the end of the day, Chipotle, which to me was going to be like off the charts, and it was, really got muted because of all of this inflation. People aren't going to go back to work all that fast. They got used to being home. They got used to that gig economy of Upwork and small projects and getting paid on Venmo. There's no reason to have to march to the train and get on and into the subway and go into your office building. It doesn't make sense. Everyone has found a new way to make ends meet.
So for So Hillary, for investors who are listening to this, how do you trade this?
Very carefully. I'm looking at a potential bullishness with the biotechs. You know, if anyone wants to be speculative, many of these biotechs haven't even started to partake in inflation and in the speculation. So there are a number of them, which we can do at another point in time. There's about 7 or 8 that are billion-dollar, backed biotechs. The other way to do it is to be really safe, because just because we're strong right now, again, we're getting ready to close those books. Next year is going to be weak. Next year is going to be a problem. So that's why I still like stocks like Ingredion, even though their earnings were a little bit shaky. It went below 90, but now it's at 95. You have a 3% dividend yield. Hormel, HRL, all the hedge funds get nervous when the market goes down. They start buying, it goes up. They have Skippy and Applegate and Spam, of course. So that's also a good one. And with Lockheed Martin having had, a earnings miss, so to speak, and the stock there having gone down, I think Lockheed Martin, LMT, we have a good entry point now for Lockheed Martin, because they're also so technology, cybersecurity driven, and they have a great client. Their biggest client is one that has lots of money and can always print it if they need more.
Yeah, we know them well, the U.S. government. Hey, Hillary, thank you so much. A good-spirited conversation and thoughtful on this Fed Wednesday. Hillary Kramer, President and Chief Investment Officer over at A&G Capital Research, on the phone from New York City. So here we are, Tim, just a few minutes left in today's trading session. We're just coming off our highs of the session, but nonetheless, I think we're looking at records for each of these major equity averages. So S&P up 31 points, the Dow well above 36,000 now at 36,165, up 115 points. NASDAQ really the outperformer, up 171 points.
How are the small caps doing too? They were on a tear earlier as Fed Chair Powell was speaking.
Yeah, I mean, they are holding on to their gains. And so we're going to see really some outperformance there. Hey, coming up next, we'll be joined by our TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close on this Fed Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here alongside Caroline Hyde and Taylor Riggs, counting you down to the closing bell, here to help take us beyond that bell. Our global simulcast partners, Carol Massar and Tim Stenovic, bringing together all of our television, radio, and YouTube audiences worldwide to parse the crucial moments of the trading day. And of course, the crucial moments of that day pretty much happened between 2 p.m. and about 3:30 p.m. East Coast time here. The market pretty much got what they wanted to hear, Carol, and it appears that this is a green light right now for risk assets.
Yeah, everything is awesome, it feels like. We definitely see stocks just coming off their highs of the session, right? What's interesting for me, those major equity averages, as you just said, Romaine, really just some outperformance there. Speaking of outperformance, the Russell, I've been watching those small caps up 2.2% at their highs today, up about 1.8% as we tick closer to the close. They're up almost 7% in the past 5 trading days. So if you're looking for some outperformance when it comes to the market, Tim, check out those small caps.
Yeah, a big takeaway for me was just that the Fed did a really good job communicating. If you see what happened in the bond market and happened in the equity market today. At the same time, I do want to draw your attention to what happened with Bitcoin right at 2 p.m., falling 3.5% before moving higher by nearly 5% from that low. So a really interesting move happening in crypto then.
Yeah, the whiplash that we see as they worry as to whether we'll have liquidity or whether it was a more dovish tone in the longer term coming from Powell. And the dollar also reaching a session low as well. Across the asset move, what's notable, Taylor, has also been the energy move as well.
Yeah, Romaine has been highlighting that as well. Caroline, I wanted to touch on that dovish tone that you mentioned. A very calm and stable 2-year yield at a 45 basis points. A lift up higher. We're now above 2% on the 20s and the 30s, Romaine, as perhaps we are learning we are going to be dealing with a little bit of the higher inflation in the long term, while we continue to focus on the labor market.
All right, getting the closing bells, 36,156 on the Dow Jones Industrial Average, up about 100 points or 0.3%. The S&P 500 also at a record high, up about 30 points here. That's led by discretionary materials and consumer staples, sitting out of that rally, energy, utilities, and industrials. The NASDAQ composite up a respectable 1% here, 161 points here. We should point out just real quickly here that Tesla really led the charge there. That's closing at a record high right around 1213. And the Russell 2000 2000, you pointed it out. This is the relative outperformer here. The Russell 2000 up about 1.8%. This is led, actually, though, largely by a lot of those discretionary names as well as healthcare. Remember, energy, utilities still kind of sitting this one out.
Meanwhile, we get the earnings thick and fast, and of course, a company that is in the line of sight when we think about supply chain issues is still continuing to do incredibly well. Qualcomm, of course, biggest maker of chips that go in your smartphones, fourth quarter adjusted revenue, $9.32 billion. The estimate was for $8.86. It's a beat, and they forecast a beat as well. First quarter revenue to $10 billion to $10.8 billion. The market had been seeing 9.73, so well ahead of expectations, and their earnings per share, a big beat as well. This is a company that is thriving in this ability to raise up prices and continue to see demand for such electronic goods at the moment. No, at the moment, worries about, of course, that Apple supply chain issue, a big supplier there.
And not earnings, but certainly some big news here. Blackstone looking to start a structured finance unit in about a $50 billion push. It's going to be this direct lending program overseen by Jonathan Pollock. Of course, all we are hearing here is they are aiming for gross originations, about $50 billion again in direct lending in 2022 would be about a 20% increase from this year's volume. Continuing to look at the real estate's, of course, debt strategies that he had overseen previously.
All right, let's also bring in Booking because we're seeing the stock actually not moving much in the after hours. But again, this really plays into the economy reopening. Are people getting back to traveling? Booking third quarter revenue, it's a beat, folks, $4.68 billion. The estimate was for $4.3 billion. Third quarter adjusted EPS, $37.70. And that, too, is a pretty significant beat. Estimate was for $32.23 a share. And gross bookings, this was key. This is what the analysts wanted to see. $23.7 billion. The estimate was for $21.63 billion. So again, it looks like some outperformance and beating certainly some of what the street was expecting, Romaine.
We're going to get back to Qualcomm in a second, but real quickly, Electronic Arts is reporting they did beat on adjusted revenue for their fiscal second quarter, $1.85 billion. The street was looking for $1.76, $1.58. That's your adjusted EPS numbers because everything's adjusted these days. The estimate was $1.17, and their guidance looking pretty strong here. I'll give you the full year only. Full year EPS $6.95. Street was looking for $6.63. Full year adjusted revenue, $7.63 billion. The street was looking for about 7.5.
Meanwhile, let's go back to Qualcomm because it's interesting that we are digging into the press release where it's all about the Internet of Things, of course. In addition to leading the 5G transition, they say they're on pace to deliver that all-important $10 billion of annual revenue across, well, what has been IoT, automotives. Our business, they say, is continuing to diversify. This coming from Cristiano Amon. He's the CEO. Overall, it's all about managing to passing on some of those cost increases, managing some of those supply chain issues that we've seen particularly affect the automotive part of those companies. And it looks as though they're still continuing to see a strong outperformance in terms of their earnings.
Yeah, and they say directly in the release here that basically they have not seen a significant impact here on their manufacturing facilities or their supply chain due to the pandemic, and that the ability of their suppliers to deliver their commitments to us or their ability to ship products to our customers.
I'm also keeping an eye on shares of Roku right now. Shares moving lower in after hours trading after third quarter net revenue comes in just slightly below estimate, $680 million, just less than $681.1 million that investors wanted to see. Shares now down about 7%, but bouncing in after hours trading. I'm going to keep an eye on any commentary about supply chain issues. The company gets about 30% of its revenue, at least last year, from the actual platform players. But there could be some concerns about supply chain disruptions there. Not many worries about advertising disruptions, and in fact, it could actually be a boon to their business. Bloomberg Intelligence says it could be the fastest growing segment, connected TVs, that is. So keep an eye on that part of the business.
That's a pretty big drop, biggest decliner right now in the post-market.
Just going to say, keeping an eye on that drop, down 6.3% for your radio listeners, because that stock is definitely some disappointment from investors. Not so disappointing is what we're getting from Booking, because we're seeing that stock now up almost 5% in the after hours. Company's CEO in the press release saying we're pleased to report another quarter of sequential improvement in room night trends, which was primarily driven by better results in Europe. Revenue in our seasonally strongest third quarter, $4.7 billion, which was more than double the amount of revenue we recognized in the second quarter of 2021. So they basically say that we're seeing some signs of recovery in many parts of the world in the third quarter. This is what we care about, Taylor, right? What we want to hear about the outlook and what's going on.
And all of these, I think we'd be remiss to continue the horse race without pausing and understanding the day that this comes on from a chairman of the Federal Reserve highlighting some of the issues within the supply chain, which, Caroline, looks like Qualcomm is really doing a good job of managing. You're getting Booking Holdings trying to show an increase here in some of the demand that they see, and a lot of questions on that call about how bond purchases affect the demand, Romaine, that frankly is already well underway.
All right, going fast and furious here with the earnings. Take-Two earnings are out here. Their quarterly number is a beat, 163 versus 140 for adjusted EPS here. I'm going to get right to their guidance here. Their guidance for the full year is pretty much in line with estimates, 3.3 to 3.4 billion revenue.
Now we take us to the President of the United States, who has
Today's a great day for
comments on
American
the
parents,
vaccine.
American families, and American children. We've taken a giant step forward to further accelerate our path out of this pandemic. After months of rigorous and independent scientific review, the Food and Drug Administration, the FDA, authorized, and the Center for Disease Control and Prevention, the CDC, recommended the COVID-19 vaccine for children ages 5 through 11. For parents all over this country, this is a day of relief and celebration. After almost 18 months of anxious worrying every time your child had a sniffle or started to cough, well, you can now protect them from this horrible virus, because that would always worry you that was coming along. 28 million more young Americans are now eligible for the protection of a vaccine. And my administration is ready. We're ready from day one, today, organized and have a plan for this vaccination's launch. As soon as next week, we'll have enough vaccine and enough places, and parents will be able to schedule appointments to get their kids their first shot. And we've already secured enough vaccine supply for every single child in America ages 5 through 11. And weeks ago, we asked states and pharmacies to put together their detailed plan to start placing their orders for these specially formulated vaccines for young children. We started packing and shipping these orders last week as soon as the FDA authorized the vaccine. We've already sent millions of doses, millions of doses, and millions more to come by next week. These doses will be available at approximately, I beg your pardon, I swallowed wrong. Will be available at approximately 20,000 locations around the country. These include places that parents know and trust, their local pharmacies, their pediatricians, family doctors, and children's hospitals. Many of the vaccine sites will offer times on nights and weekends.
We are listening to President Biden. They're making some comments on vaccines for a wider group of our population. So we'll continue to monitor. Check out LiveGo on the Bloomberg if you want to continue listening to the president's comments. In the meantime, we're going to wrap it up for Beyond the Bell, our cross-platform coverage on radio, TV, and on YouTube. Lots of earnings. We're seeing reaction in the after hours. Catch us again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, lots going on. We're seeing Booking up 6.5% in the after hours. We're seeing Roku down 7.7% in the after hours. What else do we got, Tim? It's all about earnings and what these companies had to say.
We got Booking Holdings. We got Cheesecake Factory coming really soon. You mentioned Qualcomm. Roku shares are moving lower in after hours trading. The fire hose continues, Carol.
Yeah, let's take a look at Qualcomm, because we are definitely seeing that stock move in the after hours, up about 4.3%. This is so key. This is a company that plays into all of our smartphones. We watch in terms of supply chains. The company saying tablets, wireless broadband help chip demand. Says record outlook helped by more access to supply. This is the company's CEO out in an interview. He says demand for Android phones helping growth at the company.
You're keeping an eye on Qualcomm. I got my eye on Roku because shares moving lower in after hours trading. The company coming out and saying supply chain issues to blame. Quote, we believe the slowdown in active account growth rate this quarter was in large part attributable to global supply chain disruptions that have impacted the U.S. TV market. Specifically, overall U.S. TV sales in Q3 fell below pre-COVID-19 levels. Some of our Roku TV OEM partners were hit particularly hard with inventory challenges, negatively impacting their unit sales figures and market share in the third quarter. So if you can't get that TV, that Roku TV, then you're not going to be a new account added to Roku. You're not going to see the ads, and you're not going to buy content through Roku, and that's going to hurt Roku.
Want to go back to Qualcomm, one of the big players, $156 billion market cap in the semi space. And as I mentioned, that stock is up more than 4% in the after hours. Let's get to it because a lot of it's got to have to do with that first quarter outlook, which is $10 billion to $10.8 billion, which beats the estimate of $9.73 billion. Talk about optimism. Mandeep Singh, he's the one who really gets this. He's senior tech industry analyst for us here at Bloomberg Intelligence here in our Interactive Brokers studio. Feels like an upbeat report.
Yes, it is a great print, and it just goes to show that some of the secular trends that we have been witnessing, be it digital transformation, connectivity overall, 5G rollouts, it's kind of playing into Qualcomm's strength, and that's what we are seeing in the numbers.
How are they managing it? We spend so much time talking about supply chain problems. We just did it with Fed Chief Jay Powell. Are they managing it well? Is there some reason why it doesn't necessarily seem to be hurting them too much or that much?
Yes, so
like some others?
clearly they are managing it well, and some of it has to do with the type of chips they sell. So they also use TSMC, but they use other foundries as well. And what we have seen, companies
TSMC being Taiwan
Semiconductor. So companies that have kind of diversified their foundry exposure have done well because they could source their chips from all these different foundry makers. So that is what has helped them on the supply side. In terms of demand side, really, they seem to be doing well in all the kind of segments I mentioned, except for autos. So autos is one of the high growth segments where NVIDIA has done particularly well. And that is one area where investors may want to see Qualcomm really up their game.
What do we know about pricing power? What did Qualcomm tell us about their ability to raise prices in an environment where demand is high and supply is low?
Yeah, so clearly their gross margins have improved, and that is a function of pricing. And they have been able to command, the higher prices, especially on the, the latest chips when it comes to the 5G rollouts. So whether it's the data center build out or the tablets that they're selling, it's really the latest chips that they're selling are commanding premium pricing.
I do think about like the differences, and we have to remember that because we are seeing this with companies and certainly big players in the chip sector that some manage better than others, and that's just a case like it goes to really understanding this industry, right? And you mentioned the foundries, like who are they playing into or what sector that they sell into, correct?
Yes, and look, we know industrial IoT has become a big trend after the pandemic because from an enterprise perspective, you want everything connected going forward. And that's what everyone realized during the pandemic, that if you're connected, you can get your work done. So connectivity as an overall trend is really a tailwind for all the semiconductor guys, not just Qualcomm, but Qualcomm is exposed more to mobility and 5G rollouts, and that is why they are doing well right now.
Okay, help us understand the relationship between Qualcomm and who they supply to. Apple, for example. How has that relationship changed, and what should investors know?
Yes, so with Apple, their exposure to Apple has gone down because Apple has been basically doing a lot of things in-house, and they have this system on a chip that has got everything except they still have to pay a toll to Qualcomm on the modem side. So when it comes to 5G rollout, Apple will have another chip from Qualcomm. But for the most part, they have replaced the core mobile chip that they used to use from Qualcomm with their own internal chip. So revenue exposure to Apple has gone down. Where Qualcomm has benefited is from Huawei. So because of that Huawei ban, what has happened is Qualcomm has been the main beneficiary of all the Android phones. They're selling to Xiaomi, all the Chinese handset makers, because Huawei is banned. They can't sell those. Like Qualcomm can't even sell any chips to Huawei because of the ban right now. So clearly, Qualcomm has been the beneficiary of that ban, but that whole China exposure, when you think about it, something could happen at the geopolitical level, and that has a big impact on Qualcomm. So that's something that investors have an eye on.
The thing I'm trying to figure out, and we just spent talking with one of our market guests, Hillary Kramer, about what's going on in terms of supply chain disruptions. Is it because it's such cheap money and it's ramped up demand and it's dislocating everything? But it does sound like companies are figuring out the supply chain problems, and we should maybe, can we read something more broadly, Mandeep, into this in terms of over the next quarter or so? I got to stop my question because I got to go to Mr. Biden, the president, of course. Continue to take some questions, it sounds like, on the elections that just happened here in the U.S. Mandeep, thank you. Let's go to President Biden.
For the results in Virginia and beyond last night?
Well, look, yesterday reminded me of that one of the sacred rights we have is to be able to go out and cast our votes. And remember that we all have an obligation to accept the legitimacy of these elections. I was talking to Terry to congratulate him today. He got 600,000 more votes than any Democrat ever has gotten. We brought out every Democrat about there was, more votes than ever has been cast for a Democratic incumbent. I'm not incumbent, a Democrat running for governor. And no governor in Virginia has ever won when he's of the same or he or she's the same party as the sitting president. What I do know is, I do know that people want us to get things done. They want us to get things done. And that's why I'm continuing to push very hard for the Democratic Party to move along and pass my infrastructure bill and my Build Back Better bill. I think if we, look, think about what we're talking about here. People are upset and uncertain about a lot of things, from COVID to school to jobs to a whole range of things, and the cost of a gallon of gasoline. And so if I'm able to pass, sign into law, my Build Back Better initiative, I'm in a position where you're going to see a lot of those things ameliorated quickly and swiftly. So that has to be done.
Given what you said, do you take some responsibility, and do you think that Terry McAuliffe would have won if your agenda had passed before Election Day?
Well, I think we should have passed before Election Day, but I'm not sure that I would be able to have changed the number of very conservative folks who turned out in the red districts who were Trump voters, but maybe. No, I know we did, but we also, I was running against Donald Trump.
Thank you, Mr. President. What should Democrats possibly do differently to avoid similar losses in November, especially as Republicans are now successfully running on culture war issues and false claims about critical race theory?
Well, I think we should produce for the American people. Look, one of the things that is important to understand, if they pass my legislation, we're going to be able to reduce the price. People are going to see a reduction in the price of the drugs they have to get, because Medicare will be able to negotiate and lower the price of drugs. If they pass my legislation, you're going to see that nobody, and some of you who have children in daycare or children in child care, you're paying up to $14,000 a year if you live here. You will never have to pay that much money if you live in Washington or wherever you live, no more than 7% of your income. They're going to see that, they'll get tax breaks, genuine tax breaks. If that's Trump, to tell him I'm busy. Bad joke, but anyway. But the point is that we have to move and make it clear that what we've done is increasing their look. People need a little breathing room. They're overwhelmed, and what happened was, I think we have to just produce results for them to change their standard of living and give them a little more breathing room.
My question is, what's your message, though, for Democratic voters, especially Black voters, who see Republicans running on race, education, lying about critical race theory, and they're worried that Democrats don't have an effective way to push back on that?
Well, I think that the whole answer is just to speak the truth, lay out where we are. Look, I'm convinced that if you look at everything from my view on the criminal justice system to my view on equal opportunity to my view on economic issues and all the things I have and what I've been pushing in legislation, each of the elements are overwhelmingly popular. We have to speak to them, though. We have to speak to them and explain them. Look, I just think people are at a point, and it's understandable, where there's a whole lot of confusion. Everything from, are you going to ever get COVID under control, to, are my kids going to be in school? Are they going to be able to stay in school? To whether or not I'm going to get a tax break that allows me to be able to pay for the needs of my kids and my family. And they're all things that I'm running on, that we'll run on, and I think we'll do fine.
Mr. President.
This ought to be good.
I think so too. About the way forward, Mr. President, as you were leaving for your overseas trip, there were reports that were surfacing that your administration is planning to pay illegal immigrants who are separated from their families at the border up to $450,000 each, possibly $1 million per family. Do you think that might incentivize more people to come over illegally?
If you guys keep sending that garbage out, yeah, but it's not true.
So this is a garbage report?
Yeah.
Okay, so
$450,000 per person. Is that what you're saying?
that was separated from a family member at the border under the last administration?
That's not going to happen.
Okay, and then just a follow-up, because you mentioned Trump a couple times. When you went to try to help Terry McAuliffe a couple weeks ago before you left, you mentioned Trump 24 times. Do you still think that voters really want to hear you talking about Trump more than the issues affecting them every day?
Well, the reason I mentioned Trump, if I didn't count the times, is because the issues he supports are affecting their lives every day, and they're a negative impact on their lives. Thank you all very much.
And then, of course, was President Biden there making some comments. He is still at COP26 in Glasgow, Scotland.
No, he's back here.
Oh, he is back.
He's back here, yeah.
He is back. He's just on Scotland time.
Exactly.
Just like I am on
as am I.
Scotland time. The president saying, those last questions, saying separated immigrant families will not get $450,000. That was in response to a question about that.
Yeah, I think a lot of the questions, too, focusing on the soul searching that many Democrats are doing today in the wake of painful losses for Democrats in several big elections and some close elections, too, but mainly Virginia and what happened with the governor race there. The president saying that he's continuing to push his economic agenda and saying that his agenda should have passed before Election Day. He said the Democrats will do just fine running on his agenda. The problem, though, Carol, that I think is becoming increasingly clear today and in the wake of the election that we saw is the problem with the challenge that he's had within his own party about selling his economic agenda.
Well, it's not just one party, right? And that's the problem. Or maybe some say that's the great thing about politics is that you can have some factions excuse me, within a political party. You have the progressives, you have moderates, and so, but it has definitely held up his agenda, no doubt about it. And on a day when we're looking forward to midterms and what that might mean, because then it gets a little bit more significant, right? When it comes to what a president can and cannot do, and especially when you look at what's going on in Congress right now, it would not take much for the Democrats to be able to move forward.
Literally the slimmest majority is what Democrats control the Senate by right now.
Yeah, exactly. All right, we'll continue to track, certainly when it comes to the elections. I think we're still waiting for the race in New Jersey to be called, my home state, but New Jersey Governor Phil Murphy apparently has a slight lead over the Republican challenger, so we will continue to track that. In the meantime, one of the other things that we've been tracking big time this year, thinking, all right, YOLO trading, it's done. All right, put it to bed. We're all coming back to work. We're not happening. And then you have Avis. And some others.
And some others. Well, I want to talk about this with Annie Massa. She's investing reporter at Bloomberg News. She joins us live here from New York City. Annie, the first question I got to ask you is, can you see the future? Because I would imagine that you wrote this story before we saw what happened with Avis and Bed Bath & Beyond today.
Yeah, I mean, it's actually pretty funny. When I first was thinking about writing this story several weeks ago, I was thinking, hey, maybe it's time to write a story about how YOLO trading has tapered off. And literally that day, the Trump SPAC happened. And so I had to rethink it, and I was like, you know what? YOLO trading hasn't tapered off at all. What am I talking about? Like, sure, GameStop and AMC have, fallen. AMC is still trading, far above where it was at the beginning of the year. But, like, we've had these cycles, almost like different vintages of meme stocks, and cryptos. So you had the first wave of GameStop AMC, then it was Dogecoin, then it was Shiba Inu coin, then the Trump SPAC. Now we have Avis. It's just a never-ending cycle, it seems.
Well, we love how you did this, and we talked with Bloomberg Businessweek editor Joel Weber about your take and how you guys likened it to vintages of wine, right? We're kind of moving through some different vintages.
Yeah, and each different meme episode has its own terroir.
Nicely done. Ba-dum-bum. What's interesting too is it is kind of fascinating this week. You talk about Trump in the last couple of weeks and Digital World acquisition, but the Avis beyond even Bed Bath & Beyond. Like, can we call that a meme stock?
Yeah, I mean, that's a really good question. What qualifies exactly as a meme stock now? We had a whole group of them at the beginning of the year that became popular at the same time, very obviously got hot on message boards, but it seems like an expanding definition in some ways.
Yeah.
And something that we address in this story is it's reflective of how investing has really changed in the past about 6 years. It didn't used to, even when social media and more accessible online investing became widespread, it wasn't quite as easy as it is today to see something on Reddit or Twitter or anywhere else and just quickly click into an app on your phone and buy a share or a fractional share of a company or a new cryptocurrency. So the information cycle and the ease of trading have both changed remarkably in just the past couple of years.
Well, Annie, a big part of the narrative that has emerged around meme stocks, such as the one we've been talking about, have been the role of retail traders and retail investors that they have in these meme stocks. But I wonder about Wall Street's role and to what extent you have hedge funds getting involved and the bigger companies actually tracking these meme stocks and trying to get in.
Well, we definitely saw that the hedge funds had a wake-up call in the GameStop era, and that in particular was, the things that happened with Melvin Capital, for example, just show how there needs to be a new awareness around the force with which a wave of retail traders can come into the market. And I think that hedge funds did take note of that. And, now you hear from some traders and from some firms that they have made some tweaks around how they monitor, social media phenomena.
So, wait a minute. So, just so I understand this, I mean, these people that we all thought were going to go back to work and not be able to trade because of the ease of doing it on these platforms can still be back at work, right? And trading, is that how we see this?
Well, I mean, it differs from person to person, I guess, but it's definitely easier to do just quickly on the side on your phone, maybe while you're walking out to get lunch or something, than, opening a whole desktop application like you might have had to do several years ago. So it's just getting more discreet and easier as time goes on.
Have the conversations online changed around meme stocks?
Well, I guess one prominent aspect of the GameStop run-up was trying to execute a short squeeze. So I wouldn't say that that's not the case across the boards. Some of the popularity of certain meme names, especially in crypto, are just bidding up the price of something that almost in the case of Shiba Inu coin or in the case of Dogecoin really had almost no value whatsoever, and it's just riding a wave of popularity basically.
All right, too early to say fad at this point? I mean, no, really, it's just fascinating how you set out to do one story and then it was like, Annie, it's not going to be the case.
Talk about a wake-up call, right? Now I'm going to be very cautious to call it a fad. That's all I have to say.
Well, what do you watch for then? Like, how do we kind of figure that, wait a minute, this is now, just like algorithms, right? Were at one point kind of newer to the market. They're now a part of the normal way we trade. When is there some point that you look at and say, okay, this is just a part of how trading is? It's part of our trading environment.
Yeah, I mean, we have seen the retail participation in the market taper off a little bit, but not by too much. It's still above the levels it was at least in the equity market before the pandemic hit. So this whole year and a half or so, the crazy waves that we've gone through have raised some awareness among retail investors. I guess one open question is if there were some huge market-wide sell-off or another big occurrence like that, or you had some retail traders really get burned on one of these meme names to a huge extent, that could limit the popularity going forward. But at least this year, we haven't really seen it abate. It's kind of one by one. These meme names will taper off in popularity, but something else will come up in its place, just like a game of whack-a-mole or something.
Okay, Annie, so what's it going to be? What's the next meme stock?
Whack
What's
away.
the next meme stock? Wow, I guess we're going to have to check Reddit to figure that out.
All right, like a good reporter,
right.
no speculation there.
Nose to the grindstone. When you find
Exactly.
out, let us know.
All right, Annie Massa, thank you so much. Check out that story. It is in the upcoming edition of Bloomberg Business Magazine. She is, of course, Bloomberg News investing reporter.
Well, let's get a check of what is going on with the latest business news, especially all those earnings that continue to cross. Here's Charlie Pellet.
Hi, thank you very much. Indeed, lots of earnings. Do want to begin, though, with a headline, a deal from the Bloomberg Professional Service. Continental Resources buying assets from Pioneer for $3.25 billion. But earnings, lots of them. Qualcomm shares are up by about 5%. The world's largest smartphone maker delivered a stronger than expected outlook for the current quarter, lifted by surging demand for 5G devices, as well as the company's push into new markets. Fox Corp reported quarterly sales and earnings that beat analyst estimates thanks to soaring ad sales for sports and other shows. And Etsy forecasts gross merchandise sales for the fourth quarter. That guidance did beat the average analyst estimate. Booking reported revenue for the third quarter. That's Booking.com. That revenue did beat the average analyst estimate. Shares after hours up by just about 5%. The Federal Reserve, you heard Jay Powell live on Bloomberg Radio. The Fed's going to begin winding down its monthly asset purchases later this month at a pace of $15 billion a month, while expressing less certainty that the jump in inflation will prove temporary. Here's Fed Chair Jay Powell.
Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate.
Stocks climbed to a record after the Fed signaled monetary policy will remain accommodative. The S&P, the Dow, NASDAQ 100 index, Russell 2000, all at records today, with the S&P up 30, up by 0.7%, bringing the year-to-date gain now on the S&P to 24%. The Dow up 105, up 0.3. NASDAQ up 162, up 1%. 10-year yield 1.60%. NASDAQ 100 index up 1.1%. Cannot ignore the Russell 2000 up 1.8% today. Interestingly, Dow Transport's down by 1%. Gold down 0.9%. Crude, West Texas Intermediate down 4.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Tim Stenevec and Carol Master live in the Bloomberg Interactive Brokers studio in New York. Our next guest is a familiar name to so many of our Bloomberg audience, although it has been quite a while, Carol, since you and I last spoke to him. Jim McKelvey is the co-founder of Square, also the founder and chairman of Invisibly. It's a company that helps people manage their data. He joins us now on the phone from St. Louis, Missouri.
Well, it's great. And great to have Jim back with us. Jim, how are you?
Doing great. Vaccinated and happy.
Triple or double?
Oh, double.
Yeah, same with us. We're waiting for that third.
Well, it's interesting. We have talked a lot with you about, the use of data, and this is something that it's front and center with you when it comes to data collection, managing it, data protection. And I think it's a timely conversation to continue having kind of always, but also in a week or so that we're now talking about Facebook, its name change, and its focus on the metaverse. I've talked about the metaverse more than I have in a long time. That to me says, Jim, even more data collection. How do you see it? I'm just curious.
That's what Meta stands for.
I know. But is this a good thing or worse thing? Can regulators keep up with it?
I mean, regulators are always going to follow behind popular trends. I mean, it happened with the automobile. We started building whatever we wanted, and eventually the government got involved and said, hey, look, you need to put seatbelts in this thing. And the government, had a big fight over whether we should have seatbelts in safe cars. And eventually we came to an agreement that, hey, look, airbags are good things. I think regulation is probably necessary, and it comes a little bit later because you got to see what problems you're trying to regulate. You don't want to just start regulating when there's nothing wrong.
What about when it comes to specifically the metaverse? I mean, what kind of regulations could you foresee being necessary for the metaverse?
I don't know what the metaverse is.
You're not the only
one. I can't speculate on that.
Not the only one.
Let's talk about, sort of the platforms right now have a business model that is sort of contrary to personal interests. And basically on the platforms, you're the product, and you get monetized in ways that are to the platform's benefits and not necessarily to your benefit. And I'll give you the sort of the classic example, which is that if you measure engagement and you say, well, the best thing we can do is keep our users engaged, and then you realize that one of the ways to keep people engaged is to upset them, to feed them news and messages that anger them so they get more, engaged, but they're angry. That's probably bad for the individual. Like, I don't want to go around being angry, but if Facebook wants to make me angry, they have the power to do so because they basically control what I see.
That is disturbing. And
it makes me angry.
Right, exactly. Well, it's interesting too. Well, and I think, well, exactly. But what's interesting right now is, right, when we go to sites and something, we now are able to say, okay, here's the data I want you to be able to have access to, right? We're getting a little bit more say, it feels like, although I'm never quite sure when I'm dealing with a digital world, really, how much say I ultimately really have. But it feels like we have a little bit more power. I mean, ultimately...
You really feel that way?
Which way?
That you have more power now?
No.
No,
I'm saying that, like, I'm questioning, even though, like, I'm being asked when I go to a site, like, how much data and how do you want to, I still feel like in a digital world, I feel like there's just so much out there that we have no control over.
You really want enlightened incentives. So if the platform that is giving you that so-called power is really making money by manipulating you, then they're not going to give you that power. What will typically happen is the government will say, well, you have to give users this much control, and then they'll data dump, 50 screens of ASCII code on you and say, here, have fun with it, go. Learn to write in binary. And you're just not going to be able as an individual to do that. You need somebody who's essentially working on your behalf. And right now we don't have that. We don't have an agent that represents you, Carol, in the, in intertransactions. Like, Tim's not represented. I'm right here. An agent. Yeah, an agent.
But that's what you guys are working to do at Invisibly, correct?
We're trying. I mean, we're experimenting with, invisible digital agents that work on tiny amounts of currency, like these tiny little transactions where, I'll buy or sell your attention in a way that suits you, and I'll do it in a way that hopefully is not annoying. So in other words, I'm invisible most of the time, but at the point where I do something wrong and you notice it, you can call me up and go, hey, you screwed that negotiation up. Don't do that again. You're like, don't sell my kids' data, but you're absolutely fair to trade on my sexuality. If you want to, or don't monetize my sexuality,
right.
But you can trade on my age and my demographics and all this other. Like, you tell me what's fair game, and then let the agent sort of work on your behalf.
What's interesting is we're at an era, and I'm thinking about the data collection that's just going on. Well, certainly it's happening in China, and they have incredible oversight of what they can collect from their people. I think about the people who have, tapped into 23andMe and giving away a lot of information. I mean, it's just a very weird world where I think people are still giving away so much, and do they realize the value of it, Jim?
They certainly don't. And one of the things that we had real trouble with at Invisibly was figuring out ourselves what it was worth. And it just reminds me of the days when we started Square. Like, Jack and I had no idea where the money was going.
Right.
It took us the better part of a year to find it out. And that was in the money business. It's even worse in this data world where, originally all partners that we had were just misrepresenting their numbers by factors of 10.
Wow.
So the numbers I was getting were just wildly inaccurate. And the problem is that there's so much slop in the system that, an ad could be worth a penny. It could be worth 20 cents. It could be worth, a fraction of a cent. And you just don't know. So you have to let these little markets determine what those prices are, because everyone's going to make up their own number, whatever number suits them. So it's the Wild West, and we're just trying to figure it out now.
I'm scared. All right, we're going to come back with Jim McKelvey. He's co-founder of Square, founder and chairman of Invisibly. He's also got a great book out. We've talked about it before on our air, The Innovation Stack, Building an Unbeatable Business One Crazy Idea at a Time. He's also a board member of the St. Louis Fed.
In the meantime, let's get a check of what's going on when it comes to world and national news. Denise Pellegrini standing by in the 1130 newsroom here in New York. Hey, Denise.
Hey, Tim and Carol. We do have developments for you in the New Jersey governor's race. Incumbent Democratic Governor Phil Murphy does have a slight edge now, up by more than 16,500 votes, it looks like, over Republican Jack Ciattarelli. The final vote count, though, is still continuing to come in. We're tracking it all for you here on Bloomberg Radio. Republicans, as we've been reporting this hour, are celebrating the victory of Glenn Youngkin over Democrat Terry McAuliffe in the Virginia gubernatorial race. Here's Youngkin.
My fellow Virginians.
And Youngkin is promising the largest tax refund in the history of Virginia, eliminating the grocery tax, suspending the recent gas tax, cutting taxes on retirement for veterans, and increasing the standard deduction. And there's word that Senate Democrats are weighing expanding a new minimum tax on upper-income households. And this would be in exchange for repealing a limit on state and local tax deductions, SALT deductions. More on that from Bloomberg's Amy Morris.
Sources tell Bloomberg News that some Democrats are looking at expanding the minimum income tax rates that some high earners would have to pay to help offset any benefit from a proposed expansion of the so-called SALT tax deduction. Expanding the alternative minimum tax would require some top earners to pay more in taxes even if they are eligible for other credits and deductions. This as Democrats are considering another proposal that would make the SALT deduction unlimited for 5 years. In Washington, I'm Amy Morris, Bloomberg Radio.
And I'm Denise Pellegrini, Global News 24 hours a day. On air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. And we'll have Sound On with more political news coming up in just a minute. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much. You're listening to Bloomberg Business Week. We're going to get back to Jim McKelvey, co-founder of Square, founder and chairman of Invisibly, in just a moment. In the meantime, are you squeaking in your chair over there? What the heck is going on?
There's like been a chair thing going on, right? We had to get the new chair because Matt Miller broke a chair. So the chair that I'm sitting in now.
Is that the new one?
This is the new one, and it falls down throughout the show. So I have to push it back up. Maybe I should do that during breaks, though, and not while I'm on air.
But that's a new chair, right?
It's new to me.
New to you.
Yeah.
He's squeaking. He's making a lot of noise over there.
Apologies.
In terms of crypto, we did see Bitcoin move when we got the Fed decision today.
Yeah, this was interesting. It fell 3.5% right at 2 o'clock and then shot up 5% from that higher just a few minutes later. So a really big move there. It was something that I was watching closely when we were watching the equity and bond markets, of course. But
we did see equity markets go up as well.
We did.
To their highs of the session.
Yeah, risk on day is how you would describe it, right? Well, there's an article that got our attention today on the Bloomberg terminal about the Shiba whale wallets with billions are raising alarm of crypto sleuths. The unlikely star of crypto these days is Shiba Inu. It's named after the same breed of dog that inspired the market's former unlikely meme coin darling Dogecoin. Jokes, remember. The total market value of the token, Carol, has soared to more than $51 billion last week. It leapfrogged Dogecoin, and it put it among the top 10 cryptocurrencies in existence, despite the fact that its provenance as a meme leaves it without much of a fundamental economic reason to